Good morning, everyone. Welcome to day 3 of our session, Strategic Virtual Financial Reporting Workshop. And today will be a new journey, and the journey will be journeying about how do we account for taxes in the books of accounts of a business. How do you account for taxes in the financial statements of a business, be it an entity or for a group, in line with the requirement of IFRS. Okay, we will be looking at this from the perspective of IAS 12 and IFRIC 23. And we are going to make the section as practical as possible. Okay, and I believe in the course of this discussion, we will be able to cover as much as possible all aspects of taxes as it affects our businesses. Okay, I want those that have not put up the camera to do so. Okay, remember, we want to make it as much more lively and make it a replica of a real life situation. I've sent something to the chat group for those that are making use of laptops. You could download it. Later on, I'm going to send the same document to the WhatsApp platform, where you can also have access to download. Okay, now we are going to start from the angle of what is our understanding about tax or taxation. And on that premise, we'll relate it to the source of how tax is administered. And we are going to limit the discussion from the angle of the legal perspective to where we have authority of which is jurisdictional, and that is in Nigerian context. But in the process of accounting for taxes, the principles remain the same. Okay, but the means of determining the amount of taxes is based on the requirement of the law of various jurisdictions in which a business operates, regardless of whether you are a group. Tax is domestic, tax is local, and therefore the law of the land in which you have a permanent establishment or where you have an operation will apply to you with respect to taxation. And that's what we are going to discuss. Now, the first thing we'll discuss here is I want to have little understanding from us all what is our own perspective and understanding of tax as against taxation. Are they the same? And if they are not the same, what is the difference between the two? And that will start our journey for today. And I'll give access to you all to unmute, but ensure you only unmute whenever you wanted to talk, and you mute it again when you are not talking, so that we can more or less ensure that we are orderly and we limit noise at every point in time. Okay, I'm trying to give access to you guys to unmute. I've given access for you all to unmute. Okay, let me start from, okay, I'll just give this order and let's discuss from there. Let us start from Bimisola, followed by Madam Grace, followed by Miriam, followed by Nuruddin, followed by Ladokun, followed by Donka. As others come in, we move in that order. What is your understanding of tax and how it varies or aligns with taxation in practice? You are muted. Can you unmute? You are still muted. Okay, I've not given access. No, I've allowed participants to unmute themselves. Try and do that. Okay, probably let me do it one by one then. I think I've done it one by one. You can go ahead now.
Okay, can you hear me?
Yes.
Hi everyone, good morning. My understanding of what taxes, I think you've already touched on it to say that it's a compulsory levy that is imposed by the government on individuals, on corporates, etc., in which they are expected to pay that amount of tax as an obligation. And it can be levied on profits, it can be levied on goods and services, it can be levied on income, passive income in case of withholding tax, it can be levied on profits being corporate profits, petroleum profits, capital gains profits, etc. There are different areas of tax that is being covered by different states. So you have taxes that are as applicable to the federal, to the state, and to the local. So for the federal, you will see the CIT, your TET, your CGT. For the state, you will then see your payroll, your pension, your business levy, etc. And then for your local government will be your stalls and all those radio taxes, television taxes, if they still apply right now. So my understanding of tax in a nutshell is just a compulsory levy that you have to pay, although the system or administration of tax in Nigeria right now is not at par with the Western world because technology hasn't been driven up enough to produce the output we'd like to see happen. If you look at the impact of tax on foreign direct investments, there's a school of thought that believes that the tax that is being imposed, the system, the ease of doing business, the ease of paying taxes, compared to other guys in the world is still not good enough and that the government can do better. And I guess that's why there are issues around the revamping of the tax system, the Finance Act, and ways people can sit down together and dialogue and see how we can push the Nigerian tax system forward. That's it.
Thank you. Madam Grace.
Yeah, Madam Bimsola said a lot about taxes, tax, and taxation. So I in agreement with what she has said. I just want to point out that there are still a lot of loopholes about the tax administration in Nigeria. Not all taxpayers have been captured, and the administration itself, like she said, the technology hasn't reached the level at which that everyone can pay and can have easy access to payments. So this is my view about taxes. And the other, like I said, in agreement with what she has said, she has mentioned different type of taxes, both local and the one that is being administered by the federal, the states, and the local governments. She made mention of examples of them, and I'm in agreement with what she said. That's my contribution.
Okay, thank you. Mariam. Marian, we can't hear you. Okay, can you unmute now?
Okay, hello, good morning. Can you hear
Good.
me?
Yes, we can.
Okay, so she has basically, Wemi has basically said everything, but let me just, my own understanding of tax is more like the compulsory charge that is levied on either individuals or companies. There are also different kind of taxes as regards either for personal or for company tax. Then while taxation for me is more like the act of levying, it's like the act of levying from that's like the process of imposing tax on individuals or companies. So that's my own contribution.
Okay, Nuruddin.
Good morning, everybody. Actually, Bimisola, Grace, and Marian have said a lot about what tax really means. But in my own understanding, tax is the compulsory levy on corporates and rightly individual on taxable goods and services, which is administered by government or government agencies. Okay, having said this, tax can also be viewed from both direct and indirect tax. What I mean by direct tax are the taxes levied on the income, while the indirect tax are those ones levied on consumption. Okay, like Grace said, there are loopholes in tax system in Nigeria that give room to what we understand as tax evasion and tax avoidance. And to crown it all, taxation itself is the administration of taxes in Nigerian system. Thank you.
Okay, thank you. Madam Oladokun.
Good morning. Good morning, everyone.
Good
okay,
morning.
so like it has been said, yes, so tax is the compulsory levy, which is levied on goods and services, on entities, corporations, organizations, individuals also. And we know we have the forms, we have the types of taxes, as we all know. So those tax is just the levy itself, how it comes about. But taxation is the process of levying the tax. So that's just what the two, that's the difference in both. Tax is the monetary value, the levy itself, while taxation is the process of levying the tax. That's my contribution.
Okay, Duncan.
Good morning. Good day, everyone. My colleague has said so much about the tax and taxation. I want to completely align myself with the views expressed so far. And tax is the monetary amount that comes from the process of taxation. Taxation is a process where the output is the tax. And taxation enables you to be able to know what you are going to pay, or if you are assessed properly or wrongly, be able to determine that. And so, but at the end of the day, what you get, the output is a tax, which is a monetary value.
Okay, Tiami, just coming in. Please kindly contribute. What's your understanding of tax and taxation? Tiami?
Good morning, everyone.
Good morning.
So tax is the compulsory levy imposed by the government of government on its citizens' income or profits. While taxation is the entire process of tax collection and tax management.
Okay, what's your perspective of taxation in Nigeria?
Taxation in Nigeria is a process by which all taxes, when I mean all taxes, I'm talking about taxes collected from both individuals and corporate entity, is being managed.
Okay. Okay, we've all provided our views about tax and taxation. Okay, and that view is going to serve as the basis to which our further discussions will be made. And we must understand tax itself for us to understand the appropriate way of accounting for it. And that's why I'm trying to look out for whether we really appreciate the role tax play within a business environment. Okay, now at this point, we'll look at it as a whole. Now, when we talk about tax, as we all agree, tax is a compulsory levy which is imposed by government through its agencies on every taxable person. And as we are aware, taxable persons can be an individual, taxable person can be trustees, and taxable person can be a corporate entity. Okay, even though most of our attention will be drawn to that of a corporate entity, or because a corporate entity has a responsibility to prepare financial statements, and the impact of that is what we are considering. Now, having said that, we then need to narrow ourselves to this. The kinds of taxes that corporate bodies are exposed to could be transactional and could be based on their performance, which means two aspects of taxes to which a business is exposed to are transactional and based on financial performance. Transactional taxes are taxes that are paid based on activities or events engaged in by the business. While the one based on performance or financial performance is strictly on the premise that the company has made profits, and in that case is subjected to tax because government is an unspoken stakeholder or shareholder in every business that are subject to tax. Government may not directly have contributed to capital, but indirectly, based on the application of taxation everywhere in the world, government is deemed to participate in the profit of such a business. And that's why, based on the rate of tax in various jurisdictions, certain percentage of your profits is due to government in form of taxation, which is a compulsory levy. By nature, taxation does not arise, or income tax, let me say, government taxing your profit does not arise from an agreement or from a contract you will have entered into with the government. No. It is by default that you are responsible to pay tax. And that's why in the definition of tax across the globe, it is not a levy that you pay all because you expect a benefit, even though it is expected that benefits should flow from government in terms of providing social goods, security, and all other things. But again, tax payment by corporates or any other taxable persons is not dependent on government performing its role. Okay, and that is why most times I do tell people that certain excuses we give that we don't know what the tax money is being used for is not an excuse not to pay taxes. Okay, but that doesn't mean government should not be accountable. One thing about tax is that you pay it first and cannot demand for accountability later. Not demanding for accountability first before you can justify reason for making payments. That is just from the structural perspective. Now, taxation is more or less like the administration. It's a system in which tax is administered. But again, we are not interested in the nomenclature. Whether we use the word tax or we use the word taxation, the conclusion or our understanding is that such is going to give rise to you making payments as a result of transaction you have entered into or as a result of profit you have made to government, or because directly or indirectly, it is deemed that government has provided you with the enabling environment to which you continue to operate and for which you prosper. And that's why in return, government is expected to earn something in order to keep governance rolling. Okay, that is that. Now, let us try to look out for simple history of taxation, and that will assist us in this journey, because you can't account for what you don't have sound understanding on. And that is why, by the nature of our discussion, we are going to look out for the following. Okay, let me share this screen with you. Okay, I think I've shared it directly. It's too small. Now, there are two things that have been considered in life to be certain. And those two things are taxes and debt itself. And that's why you'll find out that in different quotes, different people have made emphasis to the fact that nothing is certain in life except for taxes and debt. And also, if you go by the Holy Book, Matthew 22, chapter 22, verses 21, I'll read as it's written, that Jesus said, render to Caesar the things that are Caesar's, and to God the things that are God. Romans 13, verse 1 also says, let every person be in subjection to the governing authority, for there is no authority except from God, and those which exist are established by God. And that's why at every point in time, tax remain a compulsory levy. Okay, now let us now break it down to our bone of discussion. Before we move on, I'll share this screen and I want us to contribute, to which I'll put certain things down. And from that, we can be able to move on effectively. Now let's start from this perspective. Let us look at different types of taxes in Nigeria. Now, I think I'll grant you access again. Please, I want us to call up on taxes in Nigeria, and this will be divided into those that are more or less income-based and those that are transaction-based. Okay, can we start? What you give me is what I'm going to end up writing on the screen.
Can I just say this?
Value-added tax. Types, okay, types.
Sorry, sorry, can somebody mute the noise at the background? The first person said what? Value-added tax. Okay, next person.
Or is it personal income tax?
Personal income tax.
Education tax.
Third person talks about tertiary education tax.
Company income tax.
Somebody talks about the company income tax.
Withholding tax.
Somebody mentioned withholding tax.
Capital gain tax.
Petroleum
Somebody mentioned capital gain tax. Yeah.
PPT.
Petroleum profit
Petroleum
tax.
profit tax.
Profit tax.
Yes.
Stamp duty.
Stamp duties.
Excise duty. Stamp and excise duty.
Excise duty.
NCD levy.
Tax.
That's the local content. Development levy. NCD levy. Which other one?
Sabotage levy.
Minimum tax.
Minimum tax.
Minimum tax is not company income tax.
I will look at it all. We look at it all.
EDT, excess dividend tax.
Excess dividend tax. We are just half the way, or less than half the way. We'll be forced to.
We have consumption tax.
Yeah. Consumption tax is
Consumption
part of value-added tax.
Telecoms 1% levy.
Telecom.
The 1% levy, NTIDDA levy.
Okay. No, that means there are two separate things. There's the one for telecom is different from the information technology development levy.
Okay.
Information technology development levy. Okay.
Yeah.
Which other one?
Your cabotage levy, the ones for the shipping guys.
Cabotage levy.
Business premises, is that a levy or a tax? Business premises?
The levy.
Business premises levy.
And then we have all your radio tax, tenements, the small taxes for the local government here.
Tenement rates.
Tenement rate.
Local government.
Let's just say local government levies.
Local
So that I
government.
don't call them one by one. The levies.
Tenement rates.
Which other one?
Cop shop. Local government.
Workshop. I didn't get you. What do you say, man?
Locked up shop. A big locked up. There is a levy paid on locked up
No,
shop.
no, those ones we just put it as levy. Those ones are insignificant to the whole of those taxes.
Okay.
Okay, more.
Do they still pay that hotel consumption tax or something? Do they still?
I've added it to VAT.
Okay.
I've added it here. Okay, which other one? Which other one? What about custom duties? Which other one? Development levies? Royalties?
Yeah.
More of that? Tenement? Rate? Or land use charge? What more taxes do we have?
Toll tax.
What do you say?
Toll tax. Use a word.
Toll tax. All of those ones have summed them under LG taxes, local government taxes.
Tenement rates should go on that day.
Which one?
I mean, tenement rates should go under local government taxes.
No, that one has been hijacked by federal state governments. That land use charge.
Okay.
Okay, let's assume that these are all okay. Fundamental ones are there. Okay, okay. Let me just put sales tax. No, I won't call it sales tax. I'll just call it revenue tax. And that one, you know, NCC takes, I think, 1% of the revenue of telecoms. Is it 1% or 2%? 1%, okay? Now let us assume this is the population of taxes that companies directly or indirectly are exposed to. Okay, now we want to divide these taxes into those that arose from transactions and those that are based on income. As I've said earlier, I said I can subsume or I can subdivide taxes exposed to companies. I can divide them into two. Transactional and those that is based on financial performance. And when we say financial performance, the one that is based on what? Profit. We all know what profit is. You only make profit when you have matched your income and expense and you have net of an income. Now, let's look up here. Let me put a code there. Let's say transactional taxes are TT. And let's say taxes that is based on profit are PT. Now, let's go up here. Which of these taxes are profit taxes? PT. Now, VAT. Who can tell us about VAT? We have to pick them one by one so that we can have better understanding. We are going somewhere. VAT. Who can tell us about VAT? Who can tell us about VAT? Just short information about VAT. Please, I've given access to you guys to unmute. Okay, who will talk about VAT?
So the VAT is a consumption tax. A consumption tax. It is levied on goods and services, and it before Finance Act 2019 it was 5%, but now it has been increased to 7.5%.
Thank you. Which means VAT is on transactions that give rise to consumption of goods and services that are VATable. Okay, which means it's transaction taxes. Who can tell us about personal income tax?
Personal income tax is a tax levied on the income of an individual. As long as you work or engage in a particular employment, the income that comes to you at the end of the month or quarterly, whatever, you must pay taxes on that income.
Okay, which means this has no bearing with the business itself, only that the business or the company is an unpaid agent of the government. It deducts such and remains. Okay, let us put it under transaction. Tertiary education tax. I want Nuruddin to speak on that.
Okay, for tertiary education tax. Tertiary education tax is a portion of corporate tax imposed on corporate entity to support the education system in Nigeria. Okay, tertiary education tax is just 2% of the gross gross income of the corporate entity.
Okay, is it gross income or 2% of the accessible profit?
Oh, sorry.
Accessible
profit.
Okay, get there to know what accessible profit is in that sense. Okay, which means it is a profit tax. Is that correct?
Yes.
Yes.
Okay, company income tax, we'll talk on that.
Company income tax is tax levied on companies' taxable income or taxable profits. So having taken cognizance of your accessible profits, your expenses, to arrive at your taxable profit is the tax levied on that account.
Okay, thank you. That means the profit tax also. Withholding tax. Who will speak on withholding tax? Marian Odun.
So withholding tax is like a retention tax. It's an income tax paid to the government by the hold on. Sorry, I'm trying to. Withholding tax is like. Hello, can you hear me?
We can hear you.
Okay, so I said withholding tax is an income tax that is withheld at source from the income of an individual or a taxpayer. It's more like a retention tax.
Are you not saying it's a transaction tax or profit tax?
Transaction tax.
Okay, but you are also saying something. Okay, we'll discuss that. I'll say transaction tax. And
Can't it be either?
And I'm going to asterisk it. We'll come back here later.
I think it can be both.
That's why I'm asterisking it. At a point in time, we have to discuss on that. And probably we can reach a consensus. Okay. Next one. Capital gain tax.
Tax derived on the sale or profit of capital items.
Tax paid on what?
Profits derived from capital transactions.
Yes. Okay, that is the tax you pay on the chargeable gain of the disposal of an asset. Okay, therefore is a profit tax. Petroleum profit tax. Who will speak on that? Who will speak on that?
Tax on oil and all its associated products. So
Okay.
mineral or petroleum.
Yeah, okay. That means this is a tax you pay on profit for company involved in exploration and production of petroleum product, or let me say of crude oil. And that is also profit tax. Stamp duty. Who will speak to stamp duty?
Let me just say one or two things on stamp duty.
Okay, so, and now can you put up your camera?
Okay.
Okay.
Stamp duty is a tax on financial transactions and official documents. So it's a tax that you charge on financial transactions and official documents, such as receipts, marriage licenses, and bank transfers. Usually a flat flat, usually a flat tax. It's not usually a rate. That's what I think. But I think it's a transaction tax basically. It's not based on profit.
Okay. Thank you. Stamp duty.
So I just said it. I said, I don't know if you heard me.
I heard you.
Hello?
Yeah, repeat yourself, please.
Did you hear me? I just said it. I said stamp duty is a tax or levy on financial transactions or on official documents. Official documents like receipts, like check booklets, like special certificate that you obtain from government, and also financial transactions like transfers, bank transfers. So such things, they actually attract stamp duties, and the rate is not usually, is not a rate. Basically, usually a flat amount, is a fixed amount on such documents, like landed documents and all those things. They attract stamp duties as well.
I thought you said it was fixed amount or ad valorem. Is stamp duties always fixed?
It is a mix. It's a mix. Okay. Now, why is a document stamped?
Okay, so that you can present it. If it's not stamped, it's not presentable in court.
It's not admissible in court. Okay. Okay.
Did you hear me?
Yeah, I said it's not admissible in court.
Yes.
Okay, thank you. Now, it means it's a transaction tax.
Yes.
Excise duty. Madam Grace, you mentioned excise duty.
Yeah.
Okay, can you tell us more about it?
So it's paid on the imported goods.
On imported goods, I believe excise duty is majorly for local production.
Yes, local production, yes.
It's local production. It's of recent, based on Finance Act of 2020, that it has been extended to foreign goods that has similar, that are similar to local production, which means they will also bear excise duty, the same way local production bears excise duty. And this was done in order to not to make foreign products cheaper than local products. But conventionally, excise duty is for local production. These are levies paid on production. Okay, it's like production tax. It's also a transaction tax. What you produce, you pay tax on it locally. Okay, now I'll call it transaction tax. Nigerian Content Development Levy. Okay, it arose from local content, and what is charged is 1% of the contract value. Okay, and I'll speak to that, is a transaction tax. Who want to speak on minimum tax? Bemi, can you speak on minimum tax?
Minimum tax is tax levied when a company has little or no taxable profits at the end of its financial year. It is based on set principles, say 25% of your gross profits, of your assets, blah, blah, blah. So it's an element of CIT where you have little or no taxable profit. So I would say it is a PT.
What? What do you call it?
A PT.
PT. Okay. If it says a PT, probably I might doubt it. Let me just put question mark.
Okay.
Let me put question mark. We'll come back there. Okay, excess dividend tax. Can someone speak to that? I think maybe you mentioned it. Can you speak to that?
Oh, can I remember? Okay, so I know that the Nigerian government has tax levied on companies that are paying dividend out of paying money to their shareholders out of retained profits. So I think there's a condition or there's a cap in there. If you do not have, or if you pay out profits from, if you pay out dividend from profits that have not been taxed prior or that have been taxed and they go over a certain threshold, you might be exposed to excess dividend tax of 30%.
What it simply means is that the tax authority felt that if you declare taxable profits that is lower than the amount of dividend you paid for that year, that means something must be fishy to say, how possible are you paying more dividend than the amount of taxable profit? On that premise, you have to subject your tax to the amount of dividend rather than on your taxable profit. Therefore, can you say it is a TT or PT? I also put question mark.
Neither.
We'll come to that level to see, and we'll reach a consensus. Now let's go back. Information Technology Development Levy. Who can speak to that? Information Technology Development Levy. Who can speak to that?
Tax for IT companies and big companies that earn a certain threshold of aggregated turnover. I think they pay 1% for guys in Nigeria. I'm not sure.
Okay, Information Technology Development Levy is for companies that are grossly engaging in IT-related activities or make use of IT as a significant component of the operation. Examples are all telecommunication companies, IT companies, and financial institutions, because banks, all the operation of bank is based on IT, operation of insurance company is based on IT, operation of pension, all of those are involved in IT grossly. Otherwise, without that IT, they can't function. And this money is to finance the operation of the development of IT, information technology, and other aspects in Nigeria. Okay, and in that case, they pay 1% of their profit made in any accounting year. Therefore, we can conclude that this is profit tax. Cabotage levy. Baby spoke about that. Can you just guide us on that?
This is not fair. I think I should stop speaking. Yeah, I've forgotten all these things. Cabotage levy, isn't it for guys in maritime?
Yeah, what is the basis of that levy?
I know there's an act that supports it. I don't remember now.
Okay.
Can you save me on this one?
Okay. I believe is a levy that is paid on transaction regarding shipping activities or operation in the Nigerian territory or Nigerian waters. Okay, these are transaction taxes because it's based on activities that has been carried on other than profit of those companies. Okay, company into shipping usually are subjected to company income tax like any other company, subject to one or two variations depending on income portion that is derivable from operations within the Nigerian waters. Okay, business premises levy.
Let me
speak to that. Yeah.
Okay, business premises levy, mostly, I think is a levy that is charged by, I think, Lagos State government on properties that are used for the production of income, premises or properties that you use to generate income. So it's not for residential premises. It's for any premise, corporate premise that where you can earn income from. You charge business premises, and it's actually 10,000 naira for registration. Then every year you pay 5,000 naira in urban areas. But for rural areas, it's about 1,000 or 2,000 every year. But registration is about 10,000. So what for also for rental properties as well, but they are commercial, so you must pay that as well. So that's what I know about that.
Okay, but you said something that Lagos State. It's not Lagos State, it's all states, okay, because it's contained in the Tax and Levies Approved List for Collection Act of 1998, volume 21. Okay, now it's paid for commercial purposes, okay, or commercial or business purposes, where for every location you operate from, you have to pay a certain amount of money. And as I have said, if it's urban, you pay 5,000 per location, which means if you have 3-4 branches or locations, you pay 5,000 per each of those locations. And you do that across states in which you operate from. Okay, that is that. And it's also activity-based or event-based. Local government levies, these are transaction taxes. And that's why I shared the screen before you now that shows a lot of those taxes. Okay, they are taxes based on event or activities other than performance of the company. Okay, who will speak to custom and import duties? Who will speak to that?
So I think custom and import duties is a charge on imported goods that are coming in from outside the country into the country. So it's a charge on such goods, and it usually has usually a rate. So I think it's a transaction tax, not based on profit, for those who are into import and exports.
Okay. Therefore, transaction tax, development levy. Development levy. Who will speak to that? Development levy. Babajide, you are just coming in. Let me give you access to your mute and you speak to development levy. Okay, Babajide, you can contribute now. Babajide, are you there? Okay, who can assist since Babajide is not coming up? Anna, Anne.
Hello. Hello.
Yes.
Oh, okay. I think development levy is a charge that is paid on an individual in a year, which is solely for I think for the development of individual citizens in the country. So in a particular year, for every individual, a particular amount is paid, which is 100 naira per head.
Okay, thank you. Therefore, it means it is transaction taxes. Royalties, who will speak to royalties?
I think royalty is a levy paid to the government for the use for granting you the right to mine resources. So mine resources in the country. I think that is the transaction tax.
Okay. Royalties is tax paid on extraction of natural resources, okay? Land use charge or tenement rate.
Okay, land use charge is a charge on landed properties, usually paid to the state government. That is land use charge actually for owning landed properties in the state. So that is a transaction tax.
Okay. Thank you. Transaction tax. Now, revenue tax. For example, revenue tax are taxes that some companies that belong to certain industry pays on the revenue they earn. I'm aware of that NCC levy for telecommunication. I think they pay 1%. Is it 1% or 2%? Let me check again. NCC levy. Of the gross revenue made by telecommunication companies in Nigeria. Okay. And they collect it in order to further research and development in the area of telecommunication in Nigeria. And it's also a transaction tax.
Okay, can I say something?
Yes.
Samuel, can I say something? So you have to, add to what you just said, because also in the insurance industry, they also pay, that's a 1% to the regulator. So NICOM, the regulator.
Yeah, all of those things are
okay. I wanted to say
taxes. That okay. I can hear you.
Now, I want to say that maybe most of those regulated industries, they kind of pay such levies.
Yes, that's why I said revenue tax. Okay, okay, that is that. Now, this will more or less give us a lot of leverage against what we want to discuss. Because remember, we are all going to be doing things practically here. Okay, we'll demonstrate that understanding because we are professionals that will make use of this in our organizations or to support our clients. Therefore, we are not just going to be talking about them on the surface. We need to have better understanding of them so that in the process of accounting for them, you understand the reason why we are doing what we are doing. Now, this is to more or less bring us to the level of appreciating the difference between taxes that are considered transaction taxes and taxes that are considered income taxes. Okay, now let us now move on to where we need to move on to. We need to distinguish at every point in time income taxes from every other form of taxes. Every other form of taxes are what I consider as transaction taxes. And in that case, transaction taxes has its own modus operandi of accounting, which is different from income taxes. IAS 12 dealt extensively only with income taxes and not any other form of taxes, which means every aspect of PT we have put up here are going to be considered as income taxes, and which our discussion will be premised on the requirement of IAS 12. Why other taxes will be governed by the provision of other aspects of IFRS, and we are going to discuss that. And that's what we need to look at. Any question at this point before we start? Any question at this point before we start? Okay, if there's none, I think I'll give us 5 minutes to more or less resonate on this so that we can start the full class with respect to having to appreciate understanding of accounting for taxes in line with relevant standards. Okay, as I've said earlier, income taxes is addressed by IAS 12. And by extension, we'll have a discussion on IFIP 23. Okay, whereas other taxes, by convention, transaction taxes are accounted for in line with other IFRS standards. And we're going to see that now. Okay, let's pick VAT. VAT is a common transaction taxes or transaction tax in Nigeria that companies are exposed to. And we need to understand VAT in that sense, and that will also guide us further in his accounting. Okay, VAT. Now, the first thing we need to understand about this VAT is to appreciate that we have VATable items and we have VAT exempt goods. And in rare cases, we could have zero rated goods. And services. Now, who can speak to these three items? And from there, we can look at the accounting implications. Okay, who can speak to that? You can raise up your hand. If you cannot, unmute, and I can give you access. But I believe I've allowed you guys to unmute. Who's ready to speak to that? Alawale?
Okay, sir. Vatable goods and services are those items or services that are subjected to the 7.5% tax. The VAT exempt goods and services are those that are not subjected to the 7.5% VAT. Example of such VAT exempts are educational materials and medical items, food, agricultural products, and what have you. Zero rated goods and services, those are subjected to VAT, but at 0%. That's my submission, sir.
Okay, who else can give us something to complement him so that we can move from there?
Okay, I think is Enahoro on the line, I mean talking, is right, but basically when he said food and educational items are exempt, those ones are not exempt. Basically, they are zero rated. So they are subject to tax, but at the rate of 0. But those that are exempted basically are usually their raw materials exempted raw materials used for pharmaceutical products. So they are exempted, and also I think natural gas is also exempted. So those are the ones that are exempted. But for those that are zero rated, food items, they are subject to tax, but they are not, but are zero rate food items and as I said, educational materials.
Food items are exempted goods and services, are goods, just like you'd have exported services which are exempt. Basic food items are exempt, right? Educational materials are exempt. They are not zero rated. And I know that there was a case with the TAC with respect to what exactly is a basic food item when they were having the issue of water, pure water sachet, would that qualify? Just to add to what Olawale has said and what Enahoro has said about the VAT, what is vatable, what is VAT exempt, what is zero rated. So zero rated, like he said, is 0%. However, there is the option of claiming input tax on it. So to the extent that in the value chain that there is tax VAT levied on at 0%, whatever amount has been paid or cost that has been incurred, you can actually claim input VAT on it, depending on the level that you are or the person you are on the value chain. But we know that the final consumer has to be the person that would pay the full tax at the end of the day. But Enahoro, I'm not sure if basic food item is zero rated. To the best of my understanding, I actually think that basic food items are actually exempt.
Okay, thank you very much. Okay, our discussion here would not more or less place emphasis on which one is zero rated, which one is exempt, but rather on the principle. Okay, even though basic food items, it has been clearly defined by Finance Act of 2019, and those lists has been extended by additional schedule attached to that act. Okay, but that's not what we need to emphasize on now. What we need to emphasize is to distinguish clearly between these items. And where we need to be very, very careful of is VAT exempt and zero rated. Who can tell me critical difference between the two? With respect to this, I'll give a clue. Now, where we are going to is this. It's for us to understand that we have input tax and we have output tax. Now, whoever wants to distinguish between these two should do that, making reference to implications regarding input and output tax. Okay, but before that, who can tell me what an input tax is as opposed to an output tax?
Input tax. Input tax is the tax that is suffered by the buyer of the goods and services at the point of purchase. Emphasis on point of purchase.
How about output tax?
Output tax is a tax charged by the seller on goods and services at the point of delivery of service or sales.
Okay, if that is acceptable to us all. Now, who is ready to distinguish between the implication of VAT exempt as opposed to zero rated?
So for exempt, there is no VAT at all. So you can't even talk about an allowable input tax because there was never an output tax to start with. But for zero rated, there was tax, but at zero rates. That means that you're eligible to claim input tax to the extent that you have it. Now, input tax at the point is specific or is restrictive. It's not just when you purchase, it's when you purchase a taxable good or service that you intend to resell. So I know your emphasis was on purchase, but then you intend directly for resale or that forms part of your stock in trade. And then for items, if you pay tax on capital items, you cannot claim input tax on those ones. I think you have to amortize them with the cost of that asset.
Okay, who else wants to say something?
Okay, I think she made a very valid point, but I'll put it this way. I think input tax is just the tax that a vendor, that is a seller, can claim. The output one is the one that the seller levies on it. So in relation to VAT exempt and VAT rated, basically the VAT exempt does not have any input or output of tax, but for the zero rated, if a vendor can claim the VAT on it and claim it has actually, if a VAT has there's an element of output tax in it, so the vendor can actually claim that. That is where I see it. I don't know if that is clear.
Okay, let me come in here. Now you said it all. Anytime you pay VAT on purchases of goods or services, you conclude that such tax is an input tax. Now, accounting for it is a function of whether that item is a VATable item, it's a VAT exempt item, or is zero rated. Secondly, when you have an output tax, it is output tax because you make sales or you render services to which you make revenue. Such attract VAT. VAT on such goods sold or services rendered by you is output tax. Very simple like that. Now, accounting for output tax is also a function of whether it's a VATable item, whether it's VAT exempt item, or whether it's zero rated. Now let's go back to VATable items. VATable items are items to which they are subjected to VAT. Okay, whether as input or as output. VAT exempt are those that may have suffered VAT at the point of input, but they are exempted by way of not charging VAT at all at the point of output. Not that they are charging VAT at 0%, but they are not subjected to VAT at all. While zero-rated goods are goods that may have suffered VAT at the point of input, but at the point of output, they still suffer VAT, but at 0%. Now, what is the implication of this? Let us start with vatable items. Now, when you say vatable items, what it means is this. Let's pick a simple scenario. Let me share a screen with you. And I'll pick this simple scenario. Although the scenario I put up, which I've not amended before now, assumes VAT at 5%. Rate is not the problem. It is a principle that we are going to look at. Now, let me share this slide with you. Okay. As I said earlier, I tried to explain VAT from the angle of the position of the law. We have all discussed vatable items, VAT exempt, and zero-rated item, okay, which is what you can also see on the screen. And this more or less speaks volume to what every one of us have said, which can be considered valid. Now, let's look at this. As I've said earlier, input tax and output tax play a fundamental role in accounting for VAT in our books, subject to the fact that it's also important for us to understand that the input and output, what role do they play on VAT table goods, exempt goods, and zero-rated goods. Now, I try to break it down. Now, in doing this, I try to simplify it as far as practicable, assuming there's no withholding tax issues at all. Let's assume that all what we are dealing with, there's no withholding tax at all, so that we can be able to bring it home. Now, let's start with this. Are you aware that VAT conventionally supposed to be borne by the final consumer?
Yes.
And who is the final consumer? Yeah. It's a question that needs to be answered. And we need to be painstaking about who is the final consumer, because that affects the accounting for VAT. Now, a final consumer is deemed to be the one that consumes the goods or services without necessarily transferring such directly to another party. And consuming the goods might make you render another service as a result of that consumption. You're still going to be considered as a final consumer since you are not transferring that same item directly. And now, let's speak to the fact. Let's look at the first scenario. Whenever you suffer an input tax, for example, you buy something and you sell what you buy. When you buy that item, you pay VAT on it. That VAT will not be accounted for as the cost of that item if it's a vatable item, and if that item is considered not to have been consumed finally by you, but you will have to more or less add value to that item and transfer it to another party. That's why the word value added. Now, if I buy a good for 1,000 naira and it has suffered VAT of 7.5%, 7.5% of 1,000 naira is 75 naira. Eventually, I have incurred 1,075 naira. But in my purchase account or in my inventory account, I'm not going to account for it at 1,075. I'll account for it at 1,000, be it a debit to my purchase account or inventory. But the other debit to make up 1,075 goes into a VAT asset account. Why? Because the principle of VAT is that at every stage where value is added, you ensure that you assist government to administer that VAT such that at every point in time, until you get to the final consumer, you are collecting VAT on behalf of government. Now, since you have proved to us that you are not the final consumer, but you have paid that 75 naira, what then you have to do is that upon you selling, what you do is to also add 7.5%. Imagine you sold that goods for, let's say, 1,500 naira. You have to charge VAT of 7.5% on 1,500 naira. By the time you do that, invariably, from my calculator here, which you can also do at your own end, 7.5% of 1,500 is 112 naira 50 kobo. What that presupposes is that you sold 1.5, but your invoice will carry 1.5 plus 112.5, which means the total amount expected from your buyer is 1,612 naira 50 kobo. Now imagine that buyer pays you 1,612 naira 50 kobo. Now you are not going to recognize revenue of 1,612 kobo at 12 naira, but you are going to recognize revenue of 1.5. The difference also will go to VAT liability account. Why are we doing this? It presupposes that the VAT asset account is a refundable amount to you, since you have more or less helped government to charge VAT on the entire value which has been created. Now, what that means is that at the end of the day, you have VAT asset account of 75, and you have VAT liability account of 112.5. It then means that at the end of the day, you have to recover your 75 naira out of that 112.5. Now, what is left is the incremental charge that goes to government, which is 37 naira 50 kobo. Okay, and that is that. Now, that amount is the final VAT that is due from you to government. And accounting for it is so simple, and which is what I've done here. I pick a typical example. I said a company purchased a VATable item for 1 million naira. Now, in this case, we assume that VAT is 5% so that we don't create more of decimal. And later, the goods was sold for 1.2 million naira plus VAT of 5%. How should we account for this? Remember the clause here. This item here says VATable. Let me put a splash. I'm coming. Now, if you check here, the emphasis to this is that it's VATable. Now, since it's VATable, At the point of purchase, depending on your accounting system, you debit your inventory or purchase account with 1 million naira, being the actual cost of that good. And you debit your asset account with the VAT component of 50,000. Whether you are buying on credit or you are paying directly, your credit of 1,050,000 naira goes to your payable account or your bank account, as the case may be. Now, what is the implication of this? The 50,000 was not included in your purchase account. Why? Because that money is reclaimable at the end of the day, by the time you sell and you charge VAT. Now, let's come to the point where you've sold. What you bought for 1 million, you sold it for 1.2. And remember the clause here that it is VATable. What it signifies is that at the point of selling, you sell at 1.2 and add VAT of 5%, which is 60,000 naira. Now, at the end of the day, whether you are selling on credit or you are collecting cash at spot, you are only going to recognize revenue to the tune of 1.2 million and recognize a liability because the money you have charged is not your money. You are to collect it on behalf of the government. And therefore, that goes to VAT liability account 60,000. Now, at the end of the day, what did you find out? That at your reporting date, let us assume everything falls due on the same period. You have a recoverable amount of 50,000. You have a payable amount of 60,000. By way of internal memorandum, you cross that 50,000 against 60,000. Therefore, the balance that is now due to government is 10,000 naira. And that is accounting for VAT, for a VATable transaction. Now, we have assumed there's no withholding tax issues there. We'll come to withholding tax later. The other one is zero rated. I remember we have explained what zero rated is all about. What is zero rated? Is that zero rated is items that you purchase, whether it might have suffered VAT, but when you are to sell to somebody else, that item you are to sell qualify as zero rated. Now let's look at practical example of zero rated. Non-oil exports, goods and services purchased by diplomats, and goods purchased for use in humanitarian donor-funded projects. Now, what it simply means is this. You are selling goods, you purchase item, and you resell that item. When you purchase an item, you paid VAT because you purchased that item and you pay VAT on it. Now, if you pay VAT on it, the question then is, you will have created a VAT asset account the way we have done earlier, which is still the same thing here. But unfortunately, those that are to buy the product from you are diplomats. And by international convention, diplomats don't pay taxes. Okay. Now, if you sell an item that you'll have sold ordinarily to me and you charge VAT, but because you are selling to diplomats, you are told to charge VAT at 0%. Now, the question is this. When you charge VAT at 0%, it means there's no VAT in its real sense. Okay, 0% of anything you charge is 0. That's why I put it here. VAT liability is nil because it's 0. Now, but the issue there is this. Because it's 0 rated, you still have to claim the input tax. The only thing is that you're supposed to claim it from your output tax, but because you don't have output tax, all your goods have been sold to diplomats. Therefore, you can't deduct anything. At the end of the day, you now seek for tax refund. Okay, until you receive the tax refund in cash, it continues to be carried as what? An asset. But how does that differ from exempt goods? If you observe, input tax on vatable items and input tax on zero-rated goods are refundable taxes, provided you are not the final consumer. But input tax on exempt goods are non-refundable taxes. That's why I describe them as VAT, as a non-refundable tax. And you see the implication of what we have discussed now when you get to IAS 16, IAS 2, and some other things, where they make mention of refundable and non-refundable taxes. Now, what is the implication here? If I buy items for my production, this is common in a production line or in a service-related line. I buy raw materials that are vatable, and these raw materials go into production of my final output, but unfortunately, my final output are VAT exempt. Now, if that is the case, since I know ab initio that my final output are VAT exempt, but I've suffered input tax, in accounting for the input tax, it is non-refundable. And therefore, it must be accounted for as part of my purchase cost, rather than as VAT recoverable. Which then means that in this case, the 1 million and the VAT of 50,000 altogether will be regarded as my purchase price, because in this case, it's not refundable. And at that point, I'm deemed to be the final consumer. So that at the point of sale, I'm not charging VAT at all, whether at zero or at any rate. And that is the understanding I try to bring to the table. And I believe this demonstrates to us accounting for VAT. And an organization can more or less involve in these three issues at the same time, especially for a conglomerate. You might have a production line that the output of it is VAT exempt, but all your raw materials and other input materials are vatable items. You can have another product line where all items in and out are vatable, but you are selling to both ordinary customers and diplomats. Therefore, regardless of how complex your situation is, you can structure your accounting system in such a way that caters for all of this. And at every point in time, you're able to put the right thing in place. At this point, I want us to have one or two questions with respect to this our discussion. Any contribution?
Yeah, sir, you mentioned, I just want clarity. So you mentioned that VAT refundable and non-refundable is related to some standards. What standards are those? You mentioned it earlier.
For example, IAS 2 talks about what is the cost of an inventory. Because when you are to value inventory, you say you value inventory at cost, Abi?
Yes.
Except where the net realizable value fall below cost. The question is what make up the cost? And the standard gave guidance that the cost is based on the purchase price, less any rebates you get at the point of purchase, you understand? Plus other incidental costs. Part of the incidental costs are non-refundable taxes. And they didn't mention VAT. any tax, there can be thousands of tax, but the question is, the tax component that is part of the purchase price of a good that will constitute the cost of that goods must be those that are non-refundable. And in Nigerian context, if you look at VAT, the only non-refundable VAT is those that are exempt, arising from exempted goods and services. Does that make sense, sir?
Yes, sir. Thank you.
I want auditors to speak now. Mr. Sunday and Madam Grace, because you much more experience issues with some of your clients, especially for those that don't have a robust system.
Okay, I'm just going to set an example of one of our clients. Like there was a particular company, they are into marketing and distribution of petroleum products. They import products from overseas to sell in the country. And we all know that petroleum products, they are non-patentable at the point of dispensing or at the point of supply, but they actually paid VAT at the point of bringing in the products. So the cost of the products was valued convert. So just to buttress what you have said, that products that the company became the final consumer of that product for the purpose of VAT. So the cost of that product was treated convert, since it will not be transferred to another customer going forward.
Okay, thank you, sir.
Yeah.
Any other contribution? Any other contribution? And now, you want to say something?
Oh, no. I think it's very clear.
Nuruddin. Okay, Annie wants to say something.
I want to say something.
Okay.
Yeah, thank you very much. Actually, I actually appreciate the fact that you draw a clear distinction between the exempted goods and the zero-rated goods, because I actually have a reservation that I will ask for the rationale behind zero-rated goods. But you've explained clearly that especially for input VAT, that for the items, especially for raw materials that are suffered input VAT, but at the point of sales where the VAT is exempted, basically maybe the output is sold to a diplomat. Now, for the entity not to be at total loss of the VAT elements of the input VAT, now it will be recognized as expense for that item is a clear distinction, which I really appreciate. Thank you.
Annie. Annie. Can you unmute? Annie, can you unmute? Okay, I think the network failed her. Okay, who else want to make contribution before we move to another transaction tax? Okay, I think our network failed her. Okay, if there's no other contribution, let us now move to value-added tax. Sorry, withholding tax, sorry. That's another common transaction tax in Nigeria, and in which people barely have understanding. Luckily for us, The rate at no point has the rate of withholding tax and VAT cross-party again in Nigeria. When it was 5%, majority of withholding tax at 5%, VAT was 5%. You find out that people, even accountants, they misconstrue it, they model it up together without having clear understanding. Therefore, we want to see whether we have clear understanding. Let us discuss on withholding tax. Though I think somebody has given us a clue about withholding tax, but I want an in-depth discussion of withholding tax. Who will contribute? Who will tell us a little about withholding tax?
Well, let me just say one or two things, while others also had their own, so that I think the whole idea behind the withholding tax is that government want to kind of reduce tax evasion. I think most people, government wants the situation by when people do business, some part of the tax they will later pay is withheld. And then government actually wants companies to be kind of tax agents, because I know that tax is going to be deducted for whatever tax. If it's a company, mostly company will pay to the government. So it's a way of ensuring that people do not actually evade the tax, and then trying to reduce tax leakage in the system. That at the point of getting your money, some part of it is withheld and remitted to the government. So I don't know, the way you are filing your tax, you just use that one that has been withheld as a tax rebate or tax credit and reduce your tax liabilities. I think that's just what I think about withholding tax.
Further to what Mr. Nahuru have just said, my thinking of withholding tax is advance payment of corporate tax, which after computation of your income tax for the year can be used for offset. Like he said, is just the strategies of the government to ensure that corporate organizations make payments, make advance payments on the transaction they do in order to avoid tax evasion. That's my understanding, sir.
Okay, Mr. Sunday.
In addition to what they have said, and withholding tax is an income-related tax. That's one. Number two, it is on contracts and supplies. That is number two. Number three, contract and supply. And what else? So I forgot. I wanted to make another point as well. I forgot it for now, please. But it is income related, and it's on contract on contract and supplies. And the authorities that have the jurisdiction to administrate of tax are the various state revenue services and the federal inland revenue service as well. I think that is what comes to mind at the moment.
I agree with what everybody has said, that it's an advance payment of tax. And in some instances, this can be applied as a tax credit against your income tax liability. What the government is trying to do is to bring as much people as it can into the tax net. So you will see the government or its agency tell companies that if you have contractors or suppliers who have not given you their TIN numbers, we're trying to bring people into the tax net. But in terms of saying that it can be applied as a tax credit, depending on the transaction, it might be a final tax. So say for passive income where you have dividend being paid to foreign residents, and the withholding tax or the tax withheld on that amount. So in that instance, it will be final. There won't be a case of using it as a tax credit where you can get money back to offset in your own country. Except if there is a DTT in place.
Okay, thank you very much. That means the first point of call is that withholding tax should be seen as an advance payment of taxes or of tax. In extreme situation, withholding tax can be deemed in extreme situation, withholding tax can be deemed to be an income tax or a profit tax, as you said earlier, Gwemi, when we were listing those taxes. Can be deemed to be income tax if it is considered the final tax. If it is considered what? The final tax. Now, and we are going to demonstrate it. And certain things might be revealing to us as we move on. Now, we'll focus much more on one. The second one will be a revelation when we get to discussion on income taxes. Now, if withholding tax is an advance payment of tax, how do we account for it in our books? Now, how we account for it is very simple. Remember that in a situation where you purchased item, let me say arising from supply of goods other than in a normal course of business for 1,000 naira. Okay, and it has withholding tax implication at the rate of 5%. How would that be accounted for in your books? Now, with or without VAT, VAT has no part to cross with withholding tax. And you don't withhold by applying withholding tax rate on both the price and the VAT, no. You have to be treated separately. Remember, we have treated VAT separately. The other component other than VAT, which is your revenue that you apply withholding, which is the purchase price that you apply withholding tax on. Now, what this speaks to is that at the end of the day, when you have to make payment, or before you make payment, let me assume that this has no VAT. It's not VATable at all. Therefore, at the point of accounting, you recognize an expense, for example, whether as purchases or as expense line, and you recognize credits to your payable account, depending on the accounting system you use, which is how much? 1,000 naira. This is at invoicing point. At payment points, two things apply. Payment due or made to vendor. At that point, based on your system, you debit your payable account and you credit your mode of payment, which is your bank, with the sum of 950. 950 being 95% of the money, because 5% have to be withheld. Now, to balance it up, you need to now more or less, because at the point of payment, withholding tax for due, all things being equal, you now recognize withholding tax due. How do you recognize it? You pay 950 out of 1,000 shows as if you are still owing the vendor 50, which is not correct. Rather, you are withholding it solely for the purpose of making remittance when it falls due to the relevant tax authority. Therefore, what you do at this point is to go ahead and debit the vendor's account, which is the payable account, and credit withholding tax payable account with 50 naira. That speaks to it all. Now, this is one accounting system. Another company may use an accounting system that at the point of invoicing, this is what is created. Though you debit your expense account with 1,000 naira, but your credit will go into two accounts: payable account and withholding tax payable account, which means this first payable account is vendor payable account. And what goes there is 950. And 50 goes here. So that at the point of payment, what happens is that there's a debit directly to payable account, because in it, what is only there is 950. And upon payment of that 950, the account becomes what? Is zero. Therefore, this depends on the accounting system you use or your ERP. Okay? Now, in this case, anyone you use, you still get the same results. But I'll tell you for practice, when you are dealing with FRS, the result is not the same. Who can tell me, who has experience of it, and why would the result not be exactly the same if you are to be audited by FRS? And given that that payment was not made, it's like you have a long period of time to make that payment, and the payment cut across your accounting year. Who can explain in practical sense if you have experienced a challenge where these two are not necessarily the same results from the perspective of FRS audits? Who want to contribute? Nobody has had that experience before? Okay, let me tell you why it might not be the same. They might not be the same in the sense that if you use this first method, Assuming the services was enjoyed in November and payment might be paid in January, and your year ends in December. When you show your books will only show payable under trade payable of 1,000 naira because everything goes to payable account, vendor's account. But if you use this method and you have not paid as of December because you are still having the grace period, everything will not read under payable, trade payable. Only 950 will show under trade payable. 150 will go under other payables, which when you go to your note, you disclose it as statutory payable, or you disclose it as VAT payable if you have to, withholding tax payable if you have to break it down. Now, FRS most time when they come for audits, they will tell you, because there's this argument that goes on in practice that when is withholding tax due? Is it due at the point of invoicing or is it due at the point of payment? But today, FRS will argue that is the earlier of the two, which some of us argue that no, that you are telling me to help you withhold whenever I am paying. That is the principle anywhere in the world. Now, if part of the contract term is that I need to pay in 90 days, how can you tell me that is due from the point of invoicing? And where that challenge comes is that if you adopt this second one, let me put the highlighter. Can you see it? If you adopt this second one, I'm coming. Let me put that slash spotlight so that I can see it. If you adopt this, what simply shows is that when they pick your table, they tell you, give me schedule of this withholding tax balance as at your year end. This will be showing that it happened in November when the transaction took place. They will now tell you that November transaction is supposed to have been paid in December, not later than 21st day. But you are now trying to explain to them that no, this thing has not even been paid. But if you have used this account, by the time they check your schedule, they are not seeing anything outstanding in withholding tax payable account. And your life becomes much more easier. And that's why you find out that today, your ERP system should be flexible enough to determine which system you want to adopt. Now, every one of it has its own pros and cons. You understand? But again, you look at what is suitable for you. If we find ourselves in this situation where such argument does not arise, I would rather go for this system because I can do more analysis here to say at every point in time, I know what is due to government when it becomes due, and I know what is due to vendor when it becomes due. Because if I'm to manage my position of cash flow, you understand, I can easily manage my position with payable account, but I cannot easily manage with government because government does not go into negotiation. Immediately when it's 4 due and you are not paying, what happens? Government starts to charge penalty and what? Interest. Okay, but that is that. But what matters is that apart from accounting, what we professionals also need to look at is system that fit into our culture. You understand? So that we try to mitigate against unnecessary issues with government agencies and also better our life with respect to financial reporting. Any discussion at this point before we move ahead? Okay, it seems nobody wants to say anything there. Now, before we leave this aspect of transaction tax, have you ever come across reverse VAT? Who can tell us about reverse VAT? What is a reverse VAT? Wale, what is a reverse VAT?
when you say reverse VAT, it's like when you buy a goods or services from I'm trying to find the perfect way to put it.
Okay, who else can assist us? Bemi, can you assist us with reverse VAT?
I think it's a practice that is being misconstrued by the FIRS in line with what the VAT Act is saying. So if I recollect, I know that, well, I can't quote the relevant section of the Act. It had to do then with how much VAT is applicable when you transact with a non-resident company or person carrying on a transaction with you in Nigeria. And the fact that in as much as somebody is non-resident, VAT should apply. To the extent that you don't apply VAT on that transaction, you would be responsible for paying that VAT. So that's why you see a lot of cost companies are skeptical when they transact with non-resident company. I know there was the case with, was it Vodacom or one of these telecoms as well, who were importing satellite products or satellite cables. So basically, it's just saying that if you don't levy VAT or if you don't charge VAT when you're dealing with a particular transaction, non-resident party, you would be responsible for paying that VAT. So if you carry on transaction with vendors who are not in Nigeria and you do not apply VAT on the invoices, you will be the person that will take responsibility for that.
Okay. Thank you very much. Okay. Reverse VAT arises from activities that gives you self-administration to VAT. What it simply means is that by the nature of transactions and by the nature of the entity involved in the transaction, the law gives certain seller of goods or services, certain buyers of goods or services to self-administer VAT. And what self-administration of VAT means is that the other party selling to you by law may not be authorized to charge VAT, but you have the responsibility to pay VAT, and therefore you should charge. Yeah, sorry for my network. I'm restoring it, and that's why it's malfunctioning. Okay, now where we stop is this. I said the first level to which you can self-administer VAT is if you, as a non-resident company, as a resident company, deals with a non-resident company. Such a non-resident company will not be able to charge you VAT. Rather, the law says you should self-assess yourself to VAT, withhold it, and make remittance to the government. The second time this happened is when it was introduced to oil and gas companies. Okay, for oil and gas companies, you are more or less required to withhold VAT at every point in time. Okay, and once you have a dealing with any company, whether resident or non-resident, you are required to withhold that VAT and make remittance directly to the Federal Inland Revenue Service. That is the second time you do self-administration of VAT. The third time is what has now been introduced by the Finance Act of 2019, which says that small companies of which their turnover is not more than 25 million naira cannot charge VAT on their items. But the essence is that the government wanted to target low-income earners and promote these small businesses so that people can patronize them. And the question then is, if you as a big corporate having revenue above 25 million is doing transaction with such a company and such company cannot charge you VAT because of the law, you must self-assess yourself to tax and charge VAT at the prevailing rate of 7.5% and deduct same and remit to the government. That is what self-administration of VAT is. Which then speaks to the fact that reverse VAT will be treated separately like a withholding tax because you will charge it on yourself and you are going to account for it based on what we have discussed earlier as an input tax. But instead of you making it as a payment to the vendor, you make it as a payment to FRS directly. And that's what we are trying to say with reverse VAT. Okay, any question on that? Again, I believe that brought to clarity our understanding of reverse VAT. Okay, any question about that? Any question about that? Olawale?
Yes, sir.
What can you say about that?
Yes, from your explanation now, it's now clear to me that I'm exposed to this, but maybe the name of the reverse VAT, I didn't know that that was the name that is called. So it was the nomenclature that confused me. So I'm aware of, especially for the oil and gas companies, as long as you deal with, and you're an oil and gas company, and you deal with different vendors, you must withhold VAT on that particular invoice and remit to FRS. Also, I've been exposed to companies, small companies that their turnover is less than 25 million, and the law permit them not to, add VAT. So on that particular invoice, I'm going to add the VAT and also withhold it and remit that to the government. Likewise for non-resident companies. But the question is, these non-resident companies, so they're mostly foreign companies, sir.
Yes.
Yes. So, but sometimes I notice that majority of these vendors, the non-resident companies, they usually state in their invoices that, oh, invoices should, no tax should be deducted from their invoice because they are non-resident. They want to collect the total amount on the invoice. We should be the one to, bear whatever taxes on the invoice.
Okay, let me speak to that. That's
That's the reverse.
that issue of net of all taxes.
Yes.
Okay, is only acceptable when it's a cross-border. The reason being that the foreign company may not understand all of the tax regime in your country, so that they are not unnecessarily exposed. That's how they will tell you that this transaction we are dealing with you is net of all transaction taxes in your jurisdiction, so that if anything arises, is your own additional obligation. Okay, and that's why that you are dealing with them also, since you know the taxes in your country, for you to conclude in your contracting, you should have grossed up that item to reflect all applicable taxes at every point in time. Madam Oladoku want to ask question.
Okay. Hello, sir. If I am clear, based on your explanation of self-administration in relation to the reversed VAT, so if a small company now that is not expected to pay deals with a big company that is expected to pay, and then after transacting a business, let's assume a business of about 100,000, and since there is no withholding from the small company, when the big company is making remittances to the government, will it still pay the expected withholding, which it did not withhold from the small company? Will he still pay it on behalf of himself as a self-administration, or how is it going to work out? Hello, sir.
So let me see if I can answer that question.
Okay.
Is that okay, sir? Yeah.
Yes, 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 yes.
Okay, so I know you are saying small company and big company, but the example I would just interpose it with non-resident, just because Olawale says there were non-resident companies. So I'll start from Olawale's side. For instances where your vendors are non-resident companies and they invoice without VAT, or the contractual agreement you guys have say, look, we don't have any business with taxes, I would suggest you being knowledgeable about your Nigerian taxes, you refer them back to your VAT Act, Section 10, which says that any non-resident company that is dealing with a Nigerian, or who has a contract with a Nigerian entity, he's required to register for VAT and remit VAT. Now, for the madam here, if that company does not levy VAT, the question is, will the small company or will the local entity under the reverse charge mechanism then be required to do that? Ideally, they should not. So if your non-resident company invoices a Nigerian company without Nigerian VAT element, ideally the Nigerian company is not obligated to withhold any VAT and remit to the FIRS. However, I know that the FIRS has misconstrued, maybe in the search for revenue or targets or KPI or whatever it is, to talk about that reverse charge mechanism to say, we don't want to know what is happening. No. Section 10 of VAT already says that if a non-resident company is carrying on business in Nigeria and is required to register for VAT and levy VAT and has not done so, you, that small entity, it is from your hand who will collect that money.
Okay.
Correct, but it's just an aggressive approach to raise revenue, I guess.
Okay. I think the provision. Okay, let me use the current position as updated by the Finance Act of 2020.
Okay.
Now, a non-resident company can do business in Nigeria without necessarily creating significant economic presence or permanent establishment. Now, for example, if you buy anything, it's common to services, for example. all these digital services. Okay, if you buy anything as a company, probably you make subscription to one software that is cloud-based as a Nigerian company. Now, the company, with or without what their own jurisdiction is, might have charged you some taxes that you are not, it's not obvious to you, but they've embellished everything in their invoice pricing. Now, as a Nigerian company, if that services you are buying abroad is vatable in Nigeria, now you have the responsibility to self-administer for VAT, charge VAT at 7.5%, withhold it and remit to government. Now, that is on the premise that the company does not have a significant economic presence and doesn't have a permanent establishment. Now, let us deal with the one that has significant economic presence but do not have a permanent establishment. Now, significant economic presence does not necessarily mean that you are coming to do business in Nigeria, but the nature and the value of your business dealing in Nigeria is such that it's material to our economy, and therefore you are deemed to have created a significant economic presence. In that case, you are expected to charge VAT. But you might not be able to charge that because you are not in the know of whether there's significant economic presence or not, because you are providing a cloud service that every other companies around the world are also tapping into. Now, in that case, you still will not administer VAT because you are not even on ground. The person is just paying you in dollars online and all sorts of things. If they don't pay you, they can't get the service. Therefore, you are not bothered about how it happens. Therefore, in that case, the company that is buying also still have the responsibility to administer VAT, withhold it, and remit to the government. Now, but for those that have a permanent establishment, or that create a significant economic presence that they more or less at some point in time have to deliver that service on the shores of Nigeria, such are expected to register with the FRS. And if they are not physically present, they need to have an agent in Nigeria, which can be nominated by them. Or they can even nominate you as the buying company as the agent, who will now help them to administer that VAT, withhold it, and make remittance. Which means by default, you that you are dealing with a non-resident company has that primary obligation, even if that other company failed to do so, because the mechanism of Nigerian tax authority for enforcement cannot affect those companies because there's no way you can enforce them.
Yeah,
therefore, you can only enforce through your own entity. That is why your own entity has a primary obligation by default to do that administration on their behalf. Otherwise, they fall foul of the law. And that is a position in that case. Okay? But that is more or less tax administration in Nigeria. But again, we need to appreciate that more because it has effects on our accounting. Okay, any other issue before we move on? Any other issue before we move on? Okay.
Sorry, Mr. Moiwa.
Yeah.
So what you are saying is that for non-resident companies that we are buying goods from or services from, we need to add the VAT and withhold that VAT, then remit to government. Is that what you're saying?
Repeat it, sir.
Good. For non-resident companies, because non-resident companies. So if we are to buy goods or services from them, we are supposed to, as a company, Nigerian company, buying goods or services from a non-resident company. So we are supposed to add the VAT and also withhold it they remit it to government.
Yes,
That's
sir.
okay. Okay, thank you.
Okay. Now, let's move to another transaction tax, okay, which is payee system that is administered by company on behalf of their staff, okay, because it also has impact on your accounting. Okay, we all know that the company has responsibility to administer pay-as-you-earn scheme on behalf of the government as an unpaid agent as it relates to taxes due from its employee from employment income. Okay, now how do we account for this in our books? Okay, for simplicity, I try to create a scenario that speaks volume to that. Now let's look, for example, an employee of yours earn 1 million naira per month, which is a gross emolument. And after applying relevant tax relief allowances and other deductions based on the graduated tax table rates, his payee stood at 150,000 naira per month. Okay, the question then is, how will that payee be accounted for? Okay, assuming no pension and other related deduction from that gross pay. Okay, the first thing is that we said you need to accrue for the emolument, the gross amount. And doing so, you charge it or debit it to relevant heads of expense line, salaries and other allowance accounts, which sum up to 1 million naira. Now, you credit the net amount that will go into the employee's pockets, which will be paid to his bank account, to your salary payable accounts. And the final balance, which is the tax due, you pay it to the tax authority. And to pay it to tax authority, you credit it to your payee payable account, which is 150,000. Now that's how you do that. And upon payment of salary, you now debit the payable account and actually credit your bank account when the money actually left your bank account. And when you make remittance of payee within the first 10 days of the new month preceding or succeeding the year, the month where the salary was paid, you debit your payee payable account and you credit your bank for the payment. And that is how simple the accounting is. And that means that you need to understand this to set up your accounting system. But again, I assume that there's a pension. If there's a pension, what effect does that have in your accounting system? Now, the same scenario, but in this case, apart from the fact that the tax is 130,000, which is lower than the former one, is as a result of pension that is now being contributed. And how do you account for that? The scenario says that the employee earns 1 million, and after relevant tax relief allowances and other deductions, and based on the graduated tax rates, our payee stood at 130,000 naira. Also, pension deducted was 50,000 naira. which means invariably what goes into the pocket of the employee is 820,000 naira. Therefore, how do we account for this? At the point of accounting for the emolument, the gross amount is debited to various payroll lines, and the credit of 820,000 goes directly to the salary payable account. 130,000 goes into payee payable account, and 50,000 goes into pension payable account. Now, when salary is actually paid, 820,000 is paid through the bank, thereby debiting the salary payable account, and you credit your bank. The pension remittance of 50,000 is paid to your PFA, which is your pension fund administrator, by debiting staff pension payable account, and you credit the bank account with 50,000. While the tax remittance will also be made by a debit to staff payee payable account and a credit to the bank account. And that speaks to how simple you could create an accounting system that takes care of the remittance of your payee deduction on behalf of your employees. Any question or any contribution to this? Any question or contribution to this? Okay, which means by doing this, we've covered as far as practicable common transaction taxes that companies in Nigeria or anywhere in the world more or less are exposed to. Similar treatment in this slide is what you give to others like stamp duties, all other levies. You understand? Those ones will be accounted for straightforward as an expense by way of debit your expense line as part of your operational cost or other taxes as a line, and you credit your payable accounts. But again, any transaction taxes that is related to a CapEx, that is capital expenditure, will have to be capitalized with that expenditure. The only exception to it is that if it's a refundable tax, like VAT, it won't be capitalized. Rather, it will go into the VAT asset account because it's going to be recovered at a later date. Any question at this point? If there's no question, we'll take about 5 to 10 minutes break and we'll resume back with our discussion for the day, income taxes, where we'll be discussing the provision of IAS 12. You find out that all what we have discussed so far, will streamline it to transaction taxes. Now, we want to go into profit taxes, which is subsumed as income tax. Okay, we'll go on break now. Okay, we said our discussion now is on income taxes. What are income taxes? Okay, I think at the start of the class today, we summarize it to say that company taxes can be stratified into two. Those that are considered transaction taxes, which are all other taxes companies are exposed to other than income tax. And the second stratification is profit taxes, that is taxes that are based on profit of a company, which is known as income tax from the provision of IAS 12. Okay, now what is income tax? First, income tax can be considered as the tax that is based or charged on taxable profits, which means the basis to which the tax is assessed is the profit made by the company for the fiscal year. That's what we mean by income tax. And if you go by our discussion earlier, we more or less concluded from what I'm going to display now that our profit tax, which are income taxes, are those in green that we said PT. One of them is tertiary education tax, is an income tax. Company income tax is an income tax. Capital gain tax is an income tax. Petroleum profit tax is an income tax. And information technology development levy is an income tax. These are income taxes in Nigeria that companies are exposed to. While every other one may be considered transaction taxes, which will not be accounted for under IAS 12. Now, there are other two we more or less put a question mark. By the time we understand income tax and its treatment and requirement under IAS 12, we might come back to the minimum tax and excess dividend tax, vis-a-vis a little of withholding tax. Remember, when we discuss withholding tax, I make reference to this, where we talk about deemed to be income tax if it is considered the final tax. That will also be discussed. But let's quickly go back to our discussion about income tax. Now, income tax comprises of two components. The two components of income tax are as follows. We have the current tax and we have the deferred tax. Now, current tax is the actual tax that you are expected to pay based on the requirement of the relevant tax laws in the jurisdiction in which that entity operates. And you have to pay this to the government agencies, which is known as the tax authorities. Now, current tax is not determined with respect to the provision of IAS 12. Current tax is determined strictly with the provision of the law. IAS 12 only deals with how do we treat the resulting impact of that current tax assessment based on the law in our financial statements. And how do we present them? And only speak volume of areas that result from uncertain tax positions. Which means when we want to discuss current tax, we'll discuss it with relevant to the law that is applicable at that point in time. Now, the second component of it is the deferred tax. Now, deferred tax at the end of the day, we'll find out that it's not a tax, but rather it's an accounting measure that is used to adjust for current taxes in order to reflect income tax that is based on the financial performance of an entity, or income tax that is based on accounting profit. Are you getting it now? And that's what we want to discuss. That's why here I was able to tell you that current tax is ordinarily straightforward from accounting perspective, because you are going to place reliance on what has been done from the angle of the law. But where complexities arise is with respect to deferred tax. But this complexity is not also something that is so much, but it's something that we can easily understand and appreciate. Okay. Okay. Now, let me quickly now take us through how is current tax determined. And I'll pick Nigeria as a case study. How is current tax determined? Before we now go into IS 12 that requires us to treat it and present it in a particular manner. Let me share this screen. I'm going to open an Excel workbook where we'll be able to show one or two things there. Okay, now let me do it like this. Let me pick the company. Let's say this is a company. And we are to compute the current tax for the year of assessment. Being financial year ended 31st of December 2020. Let's say our figure in thousands. Now, what do? We start with our accounting profit, otherwise known as profits before taxes. Now let's assume, for simplicity's sake, this is 100 million. Now, the first thing we do is to carry out adjustments for two things. Or let me just narrate it, adjustment. Let me just call it tax adjustments. Tax adjustments. Now, based on our law, what are the categories of tax adjustments? From my own understanding and practice, I've broken it down into 4. Adjustments relating to non-allowable expenses. 2, non-taxable expenses. 3, omitted allowable expenses. And 4, omitted taxable income. Now we'll pick it one by one. Now, what are non-allowable expenses? Non-allowable expenses can be expenses that are not acceptable to tax authority because of what? Expenses that failed rent test. What is rent test in this case? Expenses by law and as considered by the tax authority are not only, reasonably, exclusively, and necessarily incurred in the course of carrying on the business of the entity. Some are not allowable, not because they are not expenses, but because it has a surrogate. What does that mean? It means the expenses is not deductible under the manner to which it has been accounted for in accounting. Rather, the tax law provides guidance on how such expense is allowed for tax purposes. Such expense is depreciation. And amortization. And I will explain. Of qualifying capital expenditures. QC. Why? Because capital allowance serve as a surrogate for depreciation of property, plant, and equipment. And by the provision of the Finance Act 2020, capital allowance also serve as a surrogate for the amortization cost relating to software cost or software development. And also of expenses that was accounted for in the books of account, but from the angle of the tax law, such an expense such an expense falls under a separate tax regime or is not even acceptable to tax authority at all. And such is loss on disposal of assets. Now, I can simplify this as thus. Let me put them in red. Now, also non-taxable expense. No, sorry, not taxable income, not expense. Non-taxable income. Now, there are some income by their nature are totally exempted from tax. Example of such income today is income on short-term securities, government securities, government treasury bills, government bonds, although that will elapse this year because it only was exempted for 10 years, starting from 2011. And this year, which is 2020, was the last year, okay? Which means from any such income from 2021, which will be subjected to tax in 2022, will no longer be exempted. Okay. Or if you make a gain on disposal of your shares in another company, such capital gain is not subjected to income tax. There are also some income that not that they are totally exempted from tax, but they do not fall under the regime of company income tax. Rather, they fall under the regime of capital gain tax. Example of such. Profit on disposal of assets. Such falls under the CGT regime, not under the company income tax regime. Another one are income that have suffered tax in advance. And such tax, in this case, withholding tax, is considered the final tax. E.g., dividend. I'll put that in blue. I hope I'm making sense. The third category are deemed omitted allowable expenses. Now, what do we mean? Expenses not recognized for accounting purposes. But are liable for tax what? Purposes. Who can give me an example of such an expense? I want you guys to contribute. Who can give me an example of such expense?
Intangible dwelling costs for company into exploration and production.
I can't hear you, sir.
Intangible dwelling costs for companies into production and exploration of products.
Your network is breaking, but I think I got it. I got your message. Intangible dwelling costs for company into exploration and production. Okay, I think that is even very high because of not everybody is exposed to profit, petroleum profit. Let's look at normal companies other than for E&P companies. Let's look at normal companies. Who can give me an example? Let me first put your first example, intangible dwelling costs. Which other example? Who can give me an example? Who can give me an example? Bemi, are you there? You are once a tax practitioner. Give me an example. Nuruddin, can you unmute?
Okay. Example of allowable expenses are rents, electricity.
No. I'm saying omitted. Don't let's make mistake. What I've said is this. Let me go back to the expenses not recognized for accounting purposes that you not see in your profit or loss, but are expenses for tax purposes. Somebody has said intangible dwelling cost. Yeah. I want the one for normal company.
Okay.
Bemi.
Huh?
Yes. Give us a practical example for a normal company.
So I can give you an example of an expense, but what comes to my mind, I think it will still be allowed for accounting. So if you talk about exchange differences, right? I think accounting recognizes that in as much as an allowable expense to the extent that has been crystallized.
Okay, area I'm talking about, let me just let me put it as development cost. Let me stop at that level. You know, in accounting, when we get to IAS 38.
Are you talking about pre-commencement? What do you mean by development cost?
Okay, I'm coming to, that's where I'm going to now. When you look at IAS 38, which speaks to intangible assets, research and development costs is analyzed as follows. All research costs have to be expensed for accounting purposes, whether applied, pure, or anything you call. While development costs will be capitalized provided it passed both the feasibility test and commercial viability test, which means the technical feasibility and the commercial viability. Okay, but if it does not, it will be expense. When research and development costs are expense for accounting purposes, it's in tandem with the requirement of tax where they are liable for tax purposes. But where the challenge comes is this: you incur developmental costs that qualify as intangible assets. Now, such costs will be capitalized. And the word capitalization means that you are not going to expense it. You are going to capitalize it and spread the payment, spread the cost over probably 5, 10, depending on your policy and based on the pattern of which you believe that the benefit will flow to the entity. Now, but for tax purposes, such capitalization is not recognized because there is no capital allowance for such. Therefore, such are purely expenses that will have passed the rent test, which should be expensed as incurred or as paid. And in that case, if you are preparing your financial statement, you capitalize it. You only amortize the portion that belongs to that year. But for tax purposes, you would more or less come back in this computation to say deduction of development costs, and you're going to deduct it in full. I get what I'm saying now, and that's what we are saying, that the amortized portion will be reversed, while the full development cost that was paid for will be charged as an expense. Does that make sense now, baby? Does it make sense? Another one here. Cash expense, accrued expense. Not allowed in the year it is incurred, but allowed in the current year it is paid. Now, we are all aware that government, because of its nature, deal with cash basis much than accrual basis. And why? Because government needs money at every point in time to meet its obligation, to provide security, to provide social welfare, to meet its own administrative costs, salaries, and etc. Therefore, governments barely rely on accrual because it's money that government use to execute budget, not accrual of revenue. That's why they will tell you that the reason why we cannot implement this budget in full, because cash is not coming in. And we can't borrow, or we try to borrow, but the money is not coming in. Now, there are expenses whereby by law might tell you that such expenses is not allowed for deduction because it's only accrued for, you are yet to pay it. Which means that, but accounting principle is you expense based on when you incur the cost, not necessarily when you pay. Which means that such accrual that constitute an expense last year was not allowed for you to deduct against your taxable profit until you pay for it. This year now, you are paid for it. You can't expense it in your accounting book again because its payment is just to clear your payable. It has no impact on your profit or loss. But this year, you now have to claim the deduction because last year, you were not allowed to claim the deduction because from the angle of the law, they said such is just an accrual of an expense, not expense that has actually been paid for. You find out that in the Finance Act of 2020, now, certain clarification was also made there. And also in the petroleum profit tax, which they now call hydrocarbon tax, that is before the National Assembly, They also put it there that any year you have not paid royalty, it will not be taken as a deduction in arriving at your hydrocarbon tax purposes. So that you can be owing government just accruing for it and you are not paying it and you are still enjoying tax benefit on it. Therefore, let cash benefit be enjoyed on a cash basis when actually it has been paid for. The same thing happens here. Which that means if you find yourself in that situation, this line will cover for expenses that last year I was unable to deduct because it was not yet paid for. That is that. Now, the last one. Omitted taxable income. Omitted taxable income is, for example, you have income that from your perspective, for example, somebody pay rent to you for 2 years. You know, for accounting purposes, you are going to recognize the rent for 1 year, and the one for the next year, you take it as a deferred income, which is a liability, which means your profit or loss will only show 1 year out of 2 years. But the tax law in some jurisdictions says income other than revenue are taxed on a cash basis. What it simply means is that you only more or less be taxed on the actual amount you have received, not what you have recognized as income based on accounting purposes. Therefore, what it simply means is that if you have collected rent of 2 years, though you have recognized 1 year and you have deferred 1 year, what the law says on that premise of cash basis is that that 2-year rent will be subjected to income tax in the year the rent was received. And the reason why in some jurisdictions this is done is because if you don't do that, by next year, the person has finished the 2 rents and you are assessing it to tax, it might not have the capacity or cash to pay because the money does not exist. Even though you can say you want to log the office, you want to do that, but you've lost it all. Therefore, some tax authority track income on a cash basis. What that signifies is that for tax purposes, the 2-year rent will be taken as income in that year 1. And the benefit of that is that next year, even though you are showing the 2nd year rent as income, such will no longer be subjected to tax in the 2nd year because it has been subjected to tax in the 1st year. Therefore, in this case, you can have income received in advance and of which it has been taxed on a cash what basis. Which will be taxed on a cash basis. E.g., rent received in advance. Now I'll show you the reason why I'm using different colors. Now, The color is an indication of what are we adding back and what are we deducting. Now let's look at it, for example. Expenses that is not allowed are to already be deducted before arriving at this 100,000 profit. Therefore, what do you do in that regard? You add back. Therefore, let us say the expense is like 2,000. Depreciation has been deducted and we add back. Let us say 12,000. And loss on disposal, let us say 800. Now, all of this, when you sum it together, will be added back to this 100,000. Now, non-taxable income are income that has already been added to make up 100, which will no longer be subjected to tax, or which will be subjected to tax under another regime, as I've explained earlier. Therefore, if you have this randomly, let me say I have 500, I have 1, 2, and probably I have 2,000. That also, I sum it up. Okay. Omitted allowable expenses, developmental costs that we capitalize or intangible costs we capitalize, we expense it. And finally, we have income received in advance. We have received rent for 2 years, 1.5 million per year, which means we have received 3 million. One is not in contention, the other one is in contention, the half year, that is 1.5. The one advance is 1.5, while the other 1.5 is for the current year. That has no problem. Come here. We have that. At the end of the day, the sum of all of the adjustments will give us our profits accessible to tax. So first, I can call it adjusted profit or profits adjusted for tax purposes. Simply put, profit accessible to tax or accessible what? Profit. And what is that? Now, thereafter, we have loss relief. And loss relief is a situation where a company in the preceding year or years has suffered taxable losses, not necessarily accounting losses, but taxable losses, which is yet to be totally absorbed or has not yet elapsed. And in this case, you bring the balance brought forward from previous year or years, and let's assume that we have 18,000 of it. Now, based on the law, it is subjected to availability of accessible profits. Okay, and since we have accessible profit enough to use it, therefore we can say absorb for the year. Now we can absorb this for the year. I'll just say what I can absorb is the maximum is the minimum of this and the actual amount of the loss, which is 18. Which means at no time can you redeem more than the loss, and at more time can you more or less absorb more than your accessible profits. Which means anything you cannot absorb in this year, you carry it forward, unless it has elapsed. But in this case, you are fully absorbed, therefore there's no balance to be carried. Therefore, what deduction are you taking? This. Furthermore, you have capital allowance. For capital allowance, let me see what is left. You have capital allowance. Now, peradventure, last year, you're unable to absorb all of the capital allowance. Here, you use the word relieve, not absorb profits. You're unable to absorb all of the capital allowance. Therefore, you bring it forward. Let's assume what we brought forward this year was 5,000. What was our charge for the year? The capital allowance charge from our capital allowance computation for the year or additions. Let me use the word additions for the year. Let's say additions for the year is, let me say 3.5. Which means the total to be absorbed is 8.5. Now, what can you absorb? Depending on your industry, the law says you can absorb all subject to availability of profit. While in some industry, you can absorb more than 6 to third or 2/3 of your accessible profits. Okay, most companies falls under 6 to third of accessible profits. But in this case, what you even have is far, far less than that, which means you can absorb all. Okay, therefore you can say the maximum you can absorb is the actual amount, or 66 2/3, which is 2/3 of your assessable profits. Okay? Sorry, it's the minimum, not maximum. The minimum of that, which is 85. Now, what if this 85 is lower than what is here? Let me assume that this is 83 point something. Okay, let me say this is 150. Let's see what happens. If this is 150, okay, now you have 150. You can't take more than this at any point in time. But let's take it back to our 35. Okay, now if that is the case, this is the maximum that can be absorbed, which is 8.5. Any portion you can absorb will be carried forward. As balance carried forward. Okay, now in this case, this is maximum we can deduct. And by the way I deduct all of this, at the end of the day, I arrive at my profit subjected to tax, or what I'll call my taxable profit. Now, from this is where we determine our estimated taxes. And what are my estimated taxes? The first one is the company income tax at 30% of taxable profits. And in that case, it is 30% of this. Let me write it out. 30% of how much? 7.4 million, 75.4 million. We have tertiary education tax. At 2% of assessable profits. That's 2% of how much? Our assessable profits is 101.9 million. our information technology development levy at 1% of accounting profits. That's 1% of 100 million. Okay, imagine we have capital gain tax. Capital gain tax at 10% of chargeable gains. In this case, that's 10% of, we don't know what our chargeable gain is. Therefore, we can go and do that. Let us assume we have chargeable gain. Let us try and determine chargeable gain here. Now, based on Finance Act of 2020, capital gain is now paid on actual year basis and is twice a year. Therefore, the year of assessment will change to the current year. Computation of chargeable gains. Okay. Therefore, to do that, my sales proceed let me assume there's no discount, there's nothing, and it's considered acceptable. Probably I sold something for 20 million. Less cost and cost, including incidental costs. Or incidental expenses, let me use that language. As acceptable to CGT Act. The purchase price and other are liable incidental costs. Let me say I bought it for 15. Incidental cost is 1. Therefore, deduction is 16. What's my chargeable gain? It's this. Okay. Okay, if that is the case, we come here, 10% of 4 million. Now, doing so, what do we have? 30% of this. The product of 2% of accessible profits. 1% of accounting profits. And 10% of chargeable gains. This gives us our estimated current taxes for 2020 financial year. Any questions so far? Any questions so far? Any questions so far? It's open class now, please. You can unmute yourself. Please let's have open discussion on this. Marian Odu, what's your thought? What's your view? I can't see some faces. Enaro is not there. Baby, I can't see your face. You put your camera up. Anayo, Duncan.
So you added 26058. What is that? Is that your taxable profit?
No, that's your estimated current taxes. All the taxes that constitute your income tax for the year.
Don't we need to take cognizance of any tax credits, withholding tax credits?
No, we are not looking at liability yet now. This is what goes to your income statement.
Okay, so this is the total of all the taxes, potential taxes that could be. Okay.
Yeah, to your income statement.
Okay.
Marian Odu, I'm waiting for you. I want to say something. Each one of you will say something on this before we move on.
I believe this is more like a format. So probably if we can solve a live example, and then we'll probably understand better.
What is live example other than this? What do you mean by format?
This is more like you were giving figures right from your head. It's not like you were doing.
Yeah, the same thing. The financial statement has been prepared. You are not preparing financial statement. You are extracting information from it. Therefore, is the understanding we are to discuss now? What is your view of this? Mr. Sunday.
I think it's very straightforward. I'm particularly happy for the way you explained the tax adjustments and how you subdivided it, and I think I like that format, which I think I may use going forward, at least to also bring my colleague to speed when necessary. I appreciate this presentation.
Nuruddin.
Yeah, appreciate it too.
Nuruddin.
Yes. Honestly speaking, I support what Sunday said. To be honest, this is not strange. It's not something new to us, but the orderly presentation and omitted allowable expense, omitted taxable income is something that I gain as new knowledge to what I understood before. Thank you.
Olawale. Yes, sir. My only comment here is on the chargeable gain. Is this chargeable gain, must the chargeable gain be computed along with the current taxes at every point in time, or it depends on the scenario?
Every time you disposed of an asset that is subject to capital gain tax provision, you compute the chargeable gain and the tax on it. It's a separate regime from company income tax. The same way tertiary education tax is a separate regime, and the same way information technology development levy is a separate regime. Only that the other three get their value from what you can see at a glance here. But capital gain, you have to compute it separately. And it's because of this capital gain tax that we recognize loss on disposal and profits on disposal. Where's the profit on disposal again? Yeah, it's because of that. Okay, when you now ask me that, but it's only profit that relates to capital gain. What about loss? There's what we call balancing allowance, which is a surrogate to a loss position in some situation. Do you get what I'm saying now? Okay, balancing allowance is an allowance you get when you have not enjoyed enough capital allowance for an asset you eventually sold at a loss. While balancing charge is when you have over-enjoyed capital allowance of an asset that is sold at a gain, which you have to refund the allowance. But the one you had a short enjoyment, the government have to balance it up. The one that you over-enjoy, you have to return it back to government. That's what brought about balancing allowance and balancing charge, which is good, which is discussed along with capital gain tax. Along with capital allowance, sorry. Yeah? Maybe you are saying something.
In the accessible profits line, shouldn't we then include balancing charge to the extent that we have any?
Yes, if we have, we don't have in this case. If we have balancing charge and balancing allowance, they'll be here. Okay? They'll be within the capital allowance section. Is that okay?
And all these tax, the current tax calculation is strictly related to the income statement in our financial statement.
No, this is related to financial performance. We are still going to come to presentation. I don't want to use your language so that when I explain presentation, you understand why I don't want to use your language. Even though your language might be the situation at most times, but there are exceptions to that rule.
So should we say this is what contributes to our current income tax expense?
Now, not all current income tax expense are reported in income statements. They are coming there. You know, now we are now shifting from law to financial reporting, where IAS 12 has provided us guidance, and we're going to see why. This is just to explain what current tax is. Now, who can tell me why I emphasize the word estimated current tax instead of actual current tax? A tax practitioner should be able to explain that to us. Why estimated taxes, not actual taxes? Remember, when we explain current tax, we said these are actual taxes payable to the tax authority based on current year performance. The question is, why use the word estimated rather than actual?
The reason is that by the time the tax authority call for, this amount may actually not be correct. By the time they make their own computation of the tax. So basically, this is just an estimate. So that is why I say it.
Okay, thank you very much. You got it right, but you use a phrase which we need to rephrase. You said may not be correct. Okay? It should be may not be acceptable to the tax authority. The word may not be correct means you are wrong. You are only wrong when you commit error.
Okay.
But it might not be acceptable because of their judgment, because law comes with lacuna, with gaps. Now, tax authority will want to exploit the gap to the tune of increasing taxes. Taxpayer will want to exploit the gap to reducing taxes. That's where you now meet at the middle point. Am I making sense?
Yes.
Now, but you've answered the question, which says that it is not final until it is final and conclusive. Therefore, that's when it is actual. Because it's still subject to debt review, it's still subject to tax audit, and in extreme situation, it's subject to investigation. Am I making sense, sir?
Yes, sir.
Now, in this case, it is estimated because we are aware in practice the uncertainty that surrounds tax interpretations and judgments. That's why, do you know the beauty of it is that even when you call professional and tax expert, they will not likely get the same result at all times.
Correct.
Even when you call within the same FRS, if the tax team conducts audit on the same company for the same year of assessment with the same record, two different tax teams from FRS, they are likely to get different results. Because interpretation and judgment might vary from one person to the other, depending on their perspectives. Therefore, this great lacuna, which IAS 12 also recognizes, and IAS 12 recognizes such a situation as an uncertain tax position. We are going to get there. How do we treat uncertain tax position? Does that make sense, please?
Yes, sir.
Okay. Now let's leave this computation and go back to, we've not started. We are still, playing around. Okay. But all this playing around is more critical to our understanding of what we want to do. Let's go back to our slide. Now, we all know what current tax is now. And in Nigerian context, we know what constitutes current tax to an average company. Now, income tax is the sum of current tax and deferred tax. I'm not going to discuss deferred tax now until I finish current tax, because deferred tax has its own principle, totally different from what you might expect with respect to current taxes. Therefore, we'll put that aside. But one thing we need to take away now is that current taxes and deferred taxes combined makes up what we call income taxes. And it's income taxes that you report in your financial statements, especially within the statement of profit or loss and other comprehensive income. You are not reporting current tax alone. You are not reporting deferred tax alone. You are reporting income taxes, which is current tax plus or minus what? Deferred tax. You'll be shocked. Why plus or minus? Why not plus? It's because deferred tax can either be a charge, which is an expense, or a credit, which is an income. And that's why this that I showed that in 2019, let me have my spotlight on. In 2019, deferred tax was an expense. When an expense meets an expense, it increases the expense. But in 2020, deferred tax is a credit, which is an income. When you offset an income against an expense, it reduces the expense, which means this is what you report in your statement of profit or loss and other comprehensive income for the respective years, not your current tax. Because you will start to see the shortcoming of your current tax being a tax that do not reflect your financial performance. Why? Because financial performance are based on accounting rules. But current taxes are determined with respect to tax rules and not accounting principles. That is where the differences arose. And we will now be exposed to those differences. The differences that has impact on our income tax and the differences that do not have impact on our income taxes. Now, maybe you mentioned of deduction of credit and all sorts of things. That now speaks to let's look at it. In 2019, our balance brought forward from 2018 of our tax liability was 610,000. Our current charge for 2019, which is which is 845, increases our liability. But remember, taxes are paid on a preceding year basis. All things being equal, the tax that is outstanding in 2018, this 610, should have been paid on or before 6 months in 2019, Abi? And all things being equal, it has been paid. Which means at every point in time, all things being equal, your tax liability as your current tax payable at the end of the year should always be a reflection of your current tax charge for the year. But there are exceptions to that, and I will explain as we move on. Now, your balance in 2019, 845, is brought forward in 2020. And your current tax charge in 2020, 1083, is added onto that to increase your liability in 2020. But as you are aware, your tax liability of 2019 should have been paid before the end of 2020, all things being equal. Your tax balance as at 2020 should have been carried forward. Am I making sense? That's what we're saying. Now, let's look at deferred tax. Let's assume we have deferred tax liability brought forward in 2019. Additional charge of 105 in 2019 will increase our deferred tax liability to 430, which is brought forward. And our tax credit, deferred tax credit in 2020 will reduce that liability to 327. These are what we show in our balance sheets. And by the time we get to presentation of financial statement, especially IS1 requirement, you find out that the reason why in the income statement, we combine both current and deferred tax and report it as a single item, which is income tax. But in the balance sheet, we separate current tax from deferred tax. And it is clearly stated and spelled out in IS1. Who can tell me the reason why current tax payable and deferred tax liability are not married together as one and they are shown separately? Who can tell me why?
Okay, can I just say this?
Yes.
Okay, the current tax basically is the tax that is due for payment within the next 12 months, while the deferred tax is actually not due for payment within the next 12 months.
Maybe, but there's a critical thing you need to observe. Why? Who can tell me that critical thing?
Let me try.
And also, I think the deferred tax is not due. We are not paying the deferred tax. Basically, it's not for payment. It's an asset or a liability. It's not for payment.
It's not due for payment. It's not really tax itself. It's an accrual accounting to create completeness in our current tax. And we are going to get there. When we get to deferred tax, you will appreciate the role it plays. What is actually payable to tax authority is current tax. Deferred tax is just a measure. It's like booking an accrual, depending when the actual crystallization occur of that tax liability. We'll get there. Thank you very much, Enaoro. Okay. Now, let us now ask ourselves, or let us do a recap before I move you to presentation. If you can recap, current taxes are determined by applying tax rate by legislation against taxable profits. And taxable profit has different levels. Is it total profit? Is it assessable profit? Is it chargeable profit? Is it accounting profit? Profit is defined by matching income with expense. You understand? Anything other than that is a transaction tax. Remember where we are coming from today. And you can see the beauty of why we started the way we started, so that we can better appreciate, because this is not a class where we just discuss theory. We need to demonstrate it so that by the time we get to the depth, we'll better have appreciation of why we need to have better understanding of that. Okay. Now, if you remember, I emphasized something and it's emphasized here. Okay. That what is taxable profit or loss? Is the profit or loss for a period determined in accordance with the rules established by tax authorities upon which income taxes are payable or recoverable. Now, ISF requires an unpaid tax in respect of current period or prior period to be recognized as a liability. Conversely, any excess tax paid in respect of current or prior period over what is due should be recognized as what? An asset. And Bemi, if you remember, you asked me a simple question. Now, what about tax credits? Therefore, where you have a tax credit, you recognize as assets. And that's why when you check other assets in the books of a company, you see withholding tax credit notes. You understand? Okay? And it is upon payment, you can use it to offset the amount that will actually be paid to the tax authorities. Okay. Now, let me show you this. And I want somebody to explain what will have happened in this kind of situation. What has happened in this kind of situation? Lawale, can you read out the illustration? Let us look at what has happened here and what should we do.
In 2020, ABC Limited had taxable profits of 100,000 naira. In the previous year, 2019, it has income tax profit. Income tax profit had been estimated as 20,000 naira. The tax rate given in the question is 30%. You are required to calculate tax payable and the charge for 2010 if the tax due on 2019 profit was subsequently agreed with the tax authority as A, 25,000, B, at 15,000. Note, any under or overpayment are settled until the following year's tax payment is due.
Okay. Who can speak to this? What has happened there?
Wait, sorry. I've seen 2010, I've seen 2019, I've seen 2020. I think there's a mix up 2010 and
now, wait, let me put it up together. Sorry, hold on. Yeah. No, this is 2019, not 2009. It's 2020. Is that okay? Let me share the slide again. Can you see clearly?
Okay, yes.
Okay, who will tend to answer the question and give us justification why that answer is appropriate? I'm waiting. Donka Anayo Oladokun, are you part of us? Miriam Odun, are you part of us?
Yeah.
Okay, Duncan, what can you say about that? I've not seen your face since. Put up your camera and let us and contribute.
Okay, let me quickly do that. Okay. Calculate the taxable tax payable and the charges charged for 2020 with the tax due on 2020 was subsequently agreed with the tax authority as follows. The estimated tax as at 2020 for 2019 according to the company was 20,000 naira. which means that they must have paid the 20,000 naira as a tax due to the government, and it will be carried on their book as deferred tax. Am I right?
No, continue.
Okay. And but with the new information coming up now, that the actual tax after the agreement is 25,000, that means there needs to be an adjustment for what was paid previously. That means the company is owing the tax authority extra 5,000 naira for the previous financial year. If it was agreed at 15,000, it means that the tax authority is owing the company. If the tax authority is owing the company, it's going to reduce our current year tax liability payable to the government. But if they are owing us, or if we are owing them, it's going to increase it. So I think that is my understanding of the tax payable and what is due.
Okay, now let us compare your understanding with what we have here. Now look at it. If we are to compute our tax based on the understanding we have today, our tax due will have been 30,000, which is 30% of, let me use my spotlight. It will have been 30,000, which is 30% of 100,000. But we are giving information that in 2019, we estimated it to be 20. But in 2020, when tax authority came to carry out audit, we both sat down based on judgment and some other things and agreed that, okay, the tax will have been 25. 25 not because I've made mistake, but 25 because of, remember, the issue of rent test. Is it only reasonably, and all sorts of issues that are gray in nature. And upon that, I recognize as part of uncertain tax position that I've underestimated my tax in 2019 to the tune of 25 minus 20, which is the excess of 5. What the standard says is that in the current year, such an under provision for tax will be accounted along with the current year tax as if it was incurred in that year. And this is in tandem with what we are going to discuss later with respect to the principle of how do we treat changes in accounting estimates, which is in line with the provision of IAS 8. Remember, because tax is an estimate, and gray areas there is subjected to your judgment. And therefore, anything that comes out of it is deemed to be an estimate until it has been agreed by all parties, which in this case is the tax authority and the taxpayer. Now, since we have now come to an agreement of 25, it then means that there's a change in our basis of estimation from 20 to 25. That 5 would now be taken as an adjustment against the current year tax of 30 to make up 35. Scenario B says, what if our agreement is to reduce the tax? I know some of us will laugh that in Nigeria, that one is very rare. But it's possible, or let's say it's possible. In that situation, it means you have over-provided for tax. Such over-provision will have to be reduced in the current year, which is what brought about a reduction of 5 against the current year 30 to get 25. And this is what exposes us to uncertain tax position. Does that make sense?
Yes.
Does that make sense?
Yes.
Okay, now I'll share a tax with us, and I'll give us just 5 minutes, or let me say I'll give us 10 minutes to look at those tax. You look at it individually, and we'll come together to provide solution to it. Okay, and let me share the tax with us. Okay, can we see the task? Question 1 and 2, I want us to look at it, and in 5 to 10 minutes, we'll return to the main section. Okay, can we provide solution to this? Let me look at it from my own angle, what the solution might likely be. Let me share my solution screen. Okay, the first question says, that what will have been our income tax expense for the year? All figure in millions. Now, our income tax expense will be current tax plus deferred tax. Now, what is our estimated current tax? We have the estimated tax for the year. To be 100 million. But if you check the question, we have estimated income tax in 2014, which was last year, to be 85. But in this year, 2015, we paid 90 million in full and final settlement for tax of 2014 after we have agreed that amount with FRS, which means we underpaid tax in 2014 to the tune of 5 million. Therefore, add under provision. For 2014, which is the difference between 90 and 85. That gives us 5. Invariably, I have 105. This 105 is what I'll bring forward here as 105. Now, there's no information about deferred tax. I'll simply put 0, which means my income tax is 105. Now, the second B of the question says, what is our current tax payable? My current tax payable as at the end of the year, 2015, all figure in millions, will be my balance brought forward. And my balance brought forward is the outstanding tax estimated in 2014, which is 85 million. I will add the charge for the year, which we have as 105, and that gives me 190. Less payments made during the year. What was paid during the year as agreed with FRS was 90, which is on preceding year what? Basis. What do I have? 100, which is my tax liability carried forward. Now, you find out that before now, I said our tax liability, all things being equal, should be equal to our current tax for the year. But here it's showing 105. Who can tell me the reason why it's not showing 105, but it's showing 100? Who can tell me why? Because I've said it before now that the two must be the same, all things being equal. It then signifies that all things are not being equal here. What then is the issue? What is the issue? Who wants to talk?
Okay, let me just say something. The two are not the same just because there was an on the estimation of the tax. That is just a major reason.
Yeah, so, you are right. Now, when you underestimate tax and you have come to an agreement with the FRS, that tax is immediately due for payment. You are not going to apply preceding year basis to say it will now be paid next year. No, because first, it does not relate to 2015. It's related to 2014, and 2014 tax is overdue. That's why you find out that sometimes they give you due date of 14 or 21 days, which equally come with penalty and interest. Are you getting what I'm saying now? Therefore, we need to take that into consideration. Okay, I believe these agree with most of our solutions there. If not, try to look for a correction in what we've done now. Let's look at the second one. The second one says that let me show the screen again. says that Faramade PLC financial information is as follows. Estimated tax charge for the year was 100 million. There was over provision in respect of last year. Deferred tax liability at the beginning was 5 million and deferred tax liability at the end was 3 million. What should be reported as income tax expense in profit or loss for the year? Now, to do that, what do I need to do? I go back to my solution board. My income tax expense for the year, all figure in millions, is made up of my current tax and my deferred tax. Now let's pick it one by one. What is my estimated current tax? My tax charge for the year was 100 million. Now we are given information of over provision of 10 million. We are going to treat it this year as if it's a reduction of the current year tax, which is less what? Over provision, which is 10. And that giving what? 90. This 90 is what I bring forward here as 90. Now, at the end of the year, we have deferred tax liability that has already been computed. I think they realize we have not yet gotten to that level of doing it ourselves. But they've done that for us, and they gave us balance at the beginning, and they gave us balance at the end. Opening balance was said to be 5 million. Closing balance, which is balance carried forward, is said to be 3 million. When we have opening and closing balance, what matters is for us to look at the movements during the year. That will give us either deferred tax charge or deferred tax credits. Now look at it, this is a liability account. As at the end of the year, there's a reduction in liability from 5 to 3, which is what? 2. Now, if you go back to conceptual framework, let's recall what we learned in conceptual framework. Whenever you have a reduction in an asset that brings about reduction in equity, what does the standards, what does conceptual framework says? It says such will have created something. What is that something?
If there's a reduction in assets, create a liability. There is a reduction in liability, create an asset.
Reduction in assets that brings about reduction in equity will have created an expense.
Okay.
Increase in assets that brings about increase in equity will have created an income. Conversely, reduction in liability that brings about increase in equity will have created what? An income. An increase in liability that brings about decrease in equity will have created what? Expense. Now, deferred tax liability relates to liability from the word liability. which means a reduction in this will have created a deferred tax income. And income in that regard is known as credit, which means this is a credit. And as I've said earlier in our discussion, credit will be used to reduce credit, which is income, will be used to reduce your expense to what? 88. Does that make sense now?
Yes.
I believe we all got 88. Okay. Now let's look at this together. Can somebody read this? Nurudin, can you read this? And let's attempt solving it. Are you there?
Yeah.
Okay. I'm going to share the screen. You can go ahead.
Question 8. Asna PLC made a taxable profit of 10 million in year ended 31st December 2015, on which income tax is payable at 20%. The following information are provided with respect to its income taxes. A deferred tax charge of 150,000 is required to be made to income tax expense for the year. The opening balance in the deferred tax liability account was 250,000. B, there was an estimated tax for the year ended 31st December 2014 for the sum of 1.5 million. But tax has now been agreed at 1.6 million and has since been fully paid in 2015. C, current taxes are payable every 30th June of the year preceding the year of assessment. D, in the year of 31st December 2015, Asna PLC made a capital gain of 300,000 on the disposal of a plant. This gain is taxable at a rate of 10%. Required: 1. Determine the income tax expense for the year to 31st December 2015. 2. Determine the tax liabilities to be reported in the statement of financial position as at 31st December 2015.
Okay, thank you very much. Okay, let's go back to our solution board. Now we are taught to determine income tax. As usual, our income tax expense for 2015 is as follows. All figure in thousands in this case is our current tax and our deferred tax. Now, first, in this question, because they are also aware we have not been exposed to deferred tax, they've computed it for us and they told us that there's a deferred tax charge. Charge means there's an expense of how much? 150. I recognize that. Okay, therefore, let me go ahead and determine my current tax. Current tax expense for 2015 Now, I was told that my estimated tax for the year ended is 1.5 million, which means my estimated tax for the year is 1.5 million. And we are told that, okay, sorry, estimated tax for 2014 was 1.5 million, whereas it has now been agreed as 1.6 million, which was fully paid in 2015. Let's take note of that. That's not for 2015. It's for 2014. Now, for 2015, we are told that we had taxable profit of 10 million naira, which means to determine that, 20% is our tax rate in this question. We multiply it by taxable profit, which was given at 10 million. That gives us the sum of 2 million. But we are aware of under provision in 2014, because in 2014, we recognized 1.5 million, whereas in 2015, when FRS came for audit, we agreed at 1.6 million, which was paid, which then means that I've underestimated tax in 2014 for 100. Also, we are told that we disposed of an asset in that year, which give rise to capital gain tax. We have a capital gain of 300 and the tax rate was 10%. 10% of 300,000 will give us 30,000 naira, which means all things being equal, this is 130. Okay, and I'll come here and say 2130. At the end of the day, what is my total income tax? 2280. Now I was told to show my tax liabilities. My tax liabilities as at 31st December 2015. I'm going to split them into two. Current tax payable. Remember, we have more or less explained why we separate it. And second one, deferred tax liability. We won't use the word payable for deferred tax because it's not payable. We just use the word what? Liability. Must also take note of that. Now, what is payable? We start with our opening balance brought forward. What was brought forward will be our estimated tax for 2014, all things being equal. The charge for the year, if you remember, was 2130. That gave me what? 3630. Now let's the payments made during the year. We are told that the 1.6 has been paid. Therefore, what is left? What is left should be the balance carried forward. And that is how much? 2030. And this 2030 represents 2,000 and 30,000. 2030. Because this 100 will have been paid immediately upon demand notice. Okay, that's why it was paid along with 1.5 to make up 1.6. Now for deferred tax liability, we are told that we have deferred tax liability brought forward as at the beginning of the year. Our deferred tax liability account has an opening balance of 250. Now there's a charge for the year if you remember, this 150 that was already determined for us, which means our liability has increased because the impact of additional expense on your liability is that your liability will increase in value. Therefore, our liability has increased from 250 to 400 as at the end of the year. Now, both will be shown in the balance sheet as a liability, but one will be shown as a current liability, one will be shown as non-current liability. Who can tell me which one is current and which one is non-current liability and why?
Please come again, I didn't get that.
I can explain. Which one are we going to show as a current liability and which are we going to show as non-current liability and why?
Well, current liability from where? Is it from the current tax payable or from VAT tax?
I said, which of these two, current tax payable and deferred tax liability, which one will be reported as a current liability and which one will be reported as non-current liability, and state why?
The current tax payable is current liability because it can be paid in the next within the next 6 months or 1 year. But the VAT tax definitely will not be paid.
Who else can add to that voice? Who can add to the voice?
Yes. Current tax payable will be under current liability because from the question, it will be paid at the end of the accounting year, which is 30th June. Why deferred tax liability will be deferred? Because it is just an accrual and it is a provision.
Okay. Now, that is that deferred tax liability. When we get to the discussion, you observe that it's talking about future tax consequences, which can span, which usually span for more than one accounting year. And that is why it's a non-current liability. And if it's a deferred tax asset, it's a non-current asset. Why at all times, current tax payable is current. Okay, because I've not seen any tax jurisdiction anywhere in the world where the tax that was due for the immediate prior year will be due for more than 12 months. You owing for more than 12 months does not mean it is non-current, no. Because it's immediately due. You not having ability to pay or justification not to pay is a secondary issue to that classification. Does that make sense? Okay. Let's now move to the final concluding part for today as we wrap up income taxes. Okay. Now, on certain tax position, as I've said earlier, which is what we have discussed, okay? But another thing that it could bring is it can bring about penalty and interest. And I'm going to explain that to us only when I've explained the presentation, okay? I'm coming to that. Let me skip that and let's go to presentation first. And I'll come back to this. Okay, how do we present income tax? Income tax will be presented alongside transactions that give rise to it. What does that mean? Most of the transactions that give rise to profitability are reported to profit or loss. In that regard, their income taxes will be reported into profit or loss, which means at every time we have income tax expense, we analyze it into the portion that goes into profit or loss and the portion that goes somewhere else. Now, portion that goes into profit or loss relate mainly with those items that are reported to profit or loss, which simply means that most times you see that for some companies that are not that sophisticated in transaction, report all their income taxes in profit or loss, or because no other activities are reported out of profit or loss which impact or which has a tax implication other than transaction taxes. Now, in that case, what are we saying? We are saying that at every point in time, you need to look at this. Let me show you a diagram. Let me show you this diagram, and I'm coming. So I can bring you back to speed. Can you see what I've shared? Okay. Now look at this diagram. Now look at this diagram. You'll find out that just look at the only first diagram on that slide, not the other two. Let me explain. Income tax have to be recognized along with transactions where they are reported. Those reported to profit or loss, those reported to other comprehensive income, those reported directly in equity or through business combination. And we're going to see that under business combination, but majorly, these tax returns are reported through profit or loss or other comprehensive income. What it then means is that if you don't have other comprehensive income and you have not involved in business combination, all of your income tax will be presented within income statement, profit or loss. Otherwise, it have to be reported and splitted alongside profit or loss and OCI. Now, again, how do you split it? Very easy. The way you split it is this. Let me go back to the slide, to my whiteboard. This is the way you split it. Imagine your income tax is 10,000. Now, how do I split it into the one that I'll show within profit or loss and the one I'll show within OCI? Now, remember, recall that within OCI, you could have either of these 5 items based on usual practice. Gain on revaluation, of PP. Actuarial gains or losses on defined benefit obligation. Fair value gain or losses on financial instrument carried at fair value through OCI. Foreign currency revaluation reserve or gain. Foreign currency adjustment. Let me just use the word adjustment or translation adjustment. And finally, you have effective portion of a cash flow hedge in line with IFRS 9 financial instruments. Now, if you go back to IS1 presentation, it says that in other comprehensive income, you report transaction net of their taxes. What it means is that any income tax effect on those transactions have to be accounted for and deducted before reporting the net gain or the net loss on all of this. Now, let me assume that there's a revaluation gain and the tax effects of the gain. Let me put it in red. The tax effect of the gain is such that it gives rise to tax of 300. Actuarial loss reserve give tax to the tune of 400. Fair value gain or loss give tax to the tune of 1 point. Okay, let me say 0 here. I'll tell you the reason why it's 0 here. In Nigeria, it is 0, and I'll tell you why. Foreign currency translation, let me say 1.2. And effective hedge, let me say 1.3. Now, when you add everything together, what do you have? This 7, 1.9, that's 3.2. Which means out of this 10,000, 3.2 represents OCI. Why the balance? 6.8 represents that goes to profit or loss. Now, the reason why it is 0 for fair value gain is that in Nigeria, okay, first, fair value gain is attributable to financial instruments such as shares, where gain on disposal of shares is not subjected to tax in Nigeria. Therefore, there is no tax implication, both current and deferred. Therefore, that is usually 0. That's why I say it's 0 in that case. Okay, which means if that is the case, this is how we split it. So that in your income statement, your profit, let's say, is 200,000, and your tax, instead of writing 10,000, we write 6,800, because that is the portion out of the 10,000 that goes into profit or loss as income tax expense. When you get to OCI, no matter the amount of gain on evaluation, you will net 300 out of it to show it net of tax. Actual gain, you net 400,000 to show net of tax. And that is what you do all. Which means income tax you compute in real sense is not just to be dumped in your income statement as income tax deducted from profit before tax. But in Nigeria, because most companies do not engage in activities that will have given rise to revaluation of assets, because the accounting policy choice might be cost. They might not have employee benefit with respect to defined benefit obligation that requires actuarial valuation. They might not have financial instrument at all, or the one they have are purely measured at fair value through profit or loss. Okay? They might not have more or less a non-current asset held in foreign currency that can require translation, which could bring about translation differences. And they might not even have a policy that deals with edge accounting. Therefore, all of this might not be in existence, or they are not usually in existence. That is why in Nigerian context, most businesses, especially small ones, will not have the need to be analyzing into those that affect OCI and those that affect profit or loss. And that is the position in that. Any question on that? Any question here? Any question? Yeah. Any question? Okay, it seems there's no question.
Hello, I just want to ask a question.
Yes.
Sorry, just this foreign currency translation gain or loss, does it go through OCI? I thought it goes through the profit and loss.
What goes to profit or loss are translation differences or exchange differences arising from monetary items, whether assets or liabilities. Monetary items are items that are held in a unit determinable fixed currency. Okay, examples are trade receivables, trade payables, cash balances, etc. Those are monetary items. The translation differences are reported in profit or loss, whether realized or not realized. But exchange differences arising from non-monetary items, items that, such as inventory, your stocks, your fixed assets, or what they call property, plant, and equipment, your intangible assets, all of those ones are considered non-monetary items, including investment that are carried at cost. But investment that are carried at fair value, you understand, may more or less have the impact to be translated and reported based on the position of the standard. But again, the common factor there is that when you translate balances like receivable, payable, cash, the movement affect profit or loss directly. But when you translate things like investments that are measured at fair value to other comprehensive income, or measured at amortized cost other than those measured at fair value to profit or loss, property, plant, and equipment, inventory, intangible asset, all of those are non-monetary items, and they are to be, the translation differences or exchange gain or loss will have to be reported through other comprehensive income. When you get to IAS 1, when we demystify it and we look at illustrative financial statement, we'll discuss extensively on that, and it will be clear to you. Is that okay, sir? And also, we'll discuss that in line with IAS 21, the effect of changes in exchange rates, how it affects financial statement of an entity. Does that make sense, sir?
Yes, sir.
Okay. Now, to wrap up, okay, that is what this tends to explain in terms of presentation. Okay, let me go back in. Now, let us ask ourselves a simple question. If there's a change in the estimation, last year you filed 100 million as your taxes, but this year audit review are based on your agreement with the audit of FRS, review 110 million. Therefore, FRS will issue you a demand notice for additional 10 million naira. And this comes usually with penalty and interest. Now, if it comes with penalty and interest, the question is, let us see the effect of this in our financial statements. Now, look up, please. I'll share this slide. With them is that demand notice of the FRS will come in this manner. additional tax. And this is as a result of the audit. And let's say that gives 100 million. Now it comes with penalty. Usually in Nigerian context, penalty by law is 10% flat, except if it is waived. Interest at ruling interest rate plus plus 5%. The ruling MPR rate currently is 11.5 plus 5%, let's say 16.5%. Okay, yeah, and interest, I believe, should be capped at 1 year, and it can be prorated on the basis of month. Let's say the estimation of that come to 16.5. Now, this is the demand notice given to you, 126,500. Now, and this is given to us in 2021, or let me say we are in 2020, but it relates to 2019. The question then is, we have agreed that we need to adjust against tax of 2020, okay, based on the principle of IAS 8, prospectively addressing changes in estimates, okay, which affect the year of change or the year the information is made available. Now, what are we going to adjust against our current tax for 2020? Is it the entire 26,500 or a component of the three? Now, people might misconstrue to say 126,500 should be adjusted against our income tax for 2020. But that is not correct. What is correct is that the only thing that is income tax there is additional tax, because additional tax arose from the fact that our taxable profit has changed. And remember, income tax only is arrived at based on taxable profits, not based on any other factor or basis. Therefore, we need to take that into consideration. Now, penalty is an administrative charge against additional tax. The basis of penalty is not profit. Likewise, interest is to take care of the time value of money, which is based on time for which the money has remained outstanding. Therefore, we need to take note of that these other two, though is an adjustment you are going to make in the current year, but these two will be adjusted against other lines in your income statement. Probably, penalty is usually adjusted against operating expenses, and interest will be adjusted against finance costs if it's material. If not material, it may be adjusted against operating expenses. Okay, and that is that. And that should be based on your policy. Okay, but they are not component of income tax. Additional tax is the only one that will be adjusted against our income tax as under provision, and not necessarily all of the demand notice. All of the demand notice will have to be analyzed and broken down into those that relates to OPEX, those that relates to finance costs, and those that relates to income tax. Okay. Any question? Okay. I can share this note with you guys, and I'll also share that of deferred tax material with you. Any question? Any question now before we wrap up? Extensively, we'll discuss on current taxes so that it has provided us a sound background against what we will be discussing tomorrow with respect to deferred tax. And deferred tax is so interesting and it's so fundamental to having a complete financial statement that is true and fair in all respects. Okay, you could pick the notes and you can also pick the PowerPoint.
Sorry, I
Yes,
want to confirm something, sir.
Yes, sir.
Okay, as the topic implies, IS 12 and IFRIC 23, do we have anything we need to understand in respect of IFRIC 23 as this discussion, as regards to this discussion? That's what I want to know.
Okay. Indirectly, okay, sorry, I'm coming. I'm trying to share the screen, the slide. Indirectly, we'll discuss IFRIC 23, okay, but I still will discuss it extensively when we are finished deferred tax so that we can marry them together, okay. Hold on. I'm trying to check what I'm adding for you guys. Okay, you can pick those two documents I've dropped. I think the other one I've not dropped is the Excel. Let me drop the Excel. And now, once I drop that now, I can show you what addresses your concern. My Excel is not dropping. I don't know why. Okay, but I'll share the Excel on the platform. Okay. Okay. Now let me show the slide again so that it addresses your concern. Okay, now let me give you 2 minutes to read this up. Let every other person listen to it. Can you read it up? Consensus regarding uncertain tax position with respect to tax treatment under IFRIC 23. Start from there. Whether tax treatment should be considered collectively. Start from there.
Okay, consensus. Whether tax treatment should be considered collectively. An entity is required to use judgment to determine whether each tax treatment should be considered independently or whether some tax treatment should be considered together. The decision should be based on which approach provides better predictions of the resolution of the uncertainty. Assumption for taxation authorities examinations. An entity is to assume that a taxation authority with the right to examine any amount reported to it will examine those amounts and will have full knowledge of all relevant information when doing so. Determination of taxable profit, tax loss, tax basis, unused tax losses, unused tax credits, and tax rates. An entity has to consider whether it is probable that the relevant authority will accept each tax treatment or group of tax treatments that it use or plan to use in its income tax filing. If the entity concludes that it is probable that a particular tax treatment is accepted, the entity has to determine taxable profit, bracket tax loss, tax basis, unused tax losses, unused tax credits, or tax rates consistently with the tax treatments included in its income tax filings. If the entity concludes that it is not probable that a particular tax treatment is accepted, the entity has to use most likely amount or the expected value of the tax treatment when determining taxable profit, tax loss, tax basis, unused tax losses, unused tax credits, and tax rates. The decision should be based on which method provides better predictions of the resolution of the uncertainty.
Now, the reason why I try to skip it is that they make emphasis on unused tax losses, unused tax credit, tax rate, and tax basis, all because those ones speaks to the aspect of deferred tax. When we finish deferred tax computation, okay, and the knowledge is passed on to us, we'll now come back and look again into uncertain tax position over tax treatment. And we'll be able to demonstrate that understanding here. Is that okay, sir?
Noted.
Yeah. Any other question? Okay, I believe you've downloaded the document I've sent. I can equally send it again on the platform on WhatsApp. Thank you very much, and God bless you for today. Tomorrow, we're going to start 2:30, and we're going to end it 6:30, God's willing. Okay, let's take note, 2:30. Okay, and this will accommodate everyone instead of those that will come 10 minutes, 15, 20 minutes late. And 2:30 unfailingly will commence. And tomorrow's discussion will be on deferred tax. And I don't want anybody to miss that inception because it's critical to what we'll be discussing tomorrow. We'll be laying the foundation tomorrow on deferred tax, and we are going to build upon that foundation next week. Thank you very much, and God bless you.
Thank you.
Thank you.
Bye.
Bye-bye.